dear governors, dear guests, speakers, panelists, dear colleagues, ladies and gentlemen, it's my great pleasure and privilege at the same time to welcome you at this conference organized to celebrate two important milestones for us. The first one being 30th anniversary of the Banka Slovenije, and the second one being the 15th anniversary of adoption of the euro in Slovenia. 30 years ago, the central bank of newly established republic was formed, and we were not alone. In fact, it was a thrilling period of a central bank's baby boom in this region. So I'm especially glad that I have an honor to welcome my dear colleagues from those countries which 30 years ago undergone similar transformation. Events like these are excellent opportunity for a retrospect, what has been achieved and what challenges lies ahead of us. And here, since day one, the mission of Banka Slovenije was to ensure price stability, thus helping to create favorable environment for our country to progress further. Our goal was clear back then, to become not only a successful part of European Union, but also a credible and reliable member of its core, the Eurozone. At the very start of monetary independence, our task was to introduce new currency. We started this process by issuing payment notes and then the dollar as the first official currency of the Republic of Slovenia was created. After a decade of sustained improvement in the stability of our currency, Banka Slovenije was granted with additional tasks such as overseeing the functioning of payment systems in Slovenia. As we joined the European Union back in 2004, Banka Slovenije also became a member of the European system of central banks. The following years were marked by our efforts to join the euro area, to adopt the euro as soon as possible. We succeeded just 3 years later, becoming actually the first Eurozone member after the big EU enlargement. Support and appreciation of the euro project is still well visible today. We Slovenians are always constantly among the biggest supporters of the euro inside the Eurozone. Then the series of historical achievements was followed by a financial and economic crisis. Slovenia was far from being spread. Revealed weaknesses of our banking system accumulated over more than a decade placed us in the middle of the storm. With much effort, we managed to break through it and learn valuable lessons along the way. The first one was related to banking supervision. It became part of the common interest, similarly to what monetary policy has been from the very start, under the umbrella of single supervisory mechanism. The second important lesson was related to macroprudential policy, which was designed to fill the gap between the monetary policy and the supervision policy on the other side. Like many other central banks, Banka Slovenije assumed a leading role in maintaining the stability of the financial systems. So, going forward, today, monetary policy tasks, macroprudential policy, banking supervision, together with our resolution tasks, form 4 pillars of our mandate. And we find some symbolism in that, since our facade is supported by exactly 4 statues, 4 Atlants. So, ladies and gentlemen, the last 3 decades have been truly remarkable for us. It has been a demanding but magnificent journey during which we became more experienced, stronger, and more confident about the future. Unfortunately, our resilience was put to test again in the past few years. Firstly, with the health crisis that dramatically challenged our societies, making us rethink the fundamentals of our economy and also our living habits. Secondly, with Russia's devastating military aggression against Ukraine. The security crisis had added distress to supply chains, energy, and also food security. Taking all together, these developments changed the environment we are operating in. After a long period of low inflation, in many instances, worrying low inflation, we are now faced with increasing price pressures. What started as a one-off shock, a side result of waning pandemic, is now becoming a more broad-based phenomenon. And of course, when the circumstances change, the policy response must follow. And that's why we already started with the process of normalization of our policies. And here, drawing from my personal experiences and also the experience of my institution regarding the past inflation episode in Slovenia and other countries in this part of the region, on how an idiosyncratic shock can easily and fastly transform into a more widespread dynamics, and how difficult it is to steer inflation expectations and dynamics once they get momentum. Here, I will remain supportive of our further action and even faster one, just to avoid inflation to become more persistent. But rising inflation is not the only challenge we are faced with. We are not isolated from and also not non-attentive to much broader trends happening around us. What I have in mind here are accelerated digitalization of our societies, and especially important for us in the financial sector. I think about demographic change and also about the climate change. These are the topics which we are much involved with. It's not rarely that we take a very visible role when we're providing guidance on how to cope with them. In the following sessions, there will be many opportunities for our distinguished guests to reflect on past 3 decades and share with us their views on the challenges lying ahead of us. But before that, it's my great pleasure to invite President Lagarde to share with us her thoughts. Dear Christine, please, the floor is yours.
Dobar dan. I wish I could carry on in Sloven, but I'm privileged as president of the European Central Bank to be surrounded by wonderful, talented economists, jurists, and other Europeans of all corners of the euro area, including from Slovenia. So thanks to them for having helped me along the way, as well as all the others, of course. But it's a pleasure to be back in Ljubljana. Thank you very much, Boštjan, for your introduction, and thank you very much for your hospitality and that of your institution. I was asked to talk about the road already traveled and contemporary challenges. So I could have talked about anything, but I had to be a little bit selective, and it's in my position as president of the European Central Bank and of the Eurosystem that I'm now going to address this wonderful audience gathered here for the anniversary of the Central Bank. And I believe that Europe and the euro area can learn a great deal from the journey of Slovenia in recent decades that you have very aptly summarized shortly. Your country has faced and overcome serious challenges over the years, and I'll just mention a few. Independence from Yugoslavia as it was, joining the EU, adopting the euro, which is very nicely displayed in the exhibition that you have behind you, overcoming the crisis that erupted in 2013, and now the pandemic overlaid with the terrible Russian war against Ukraine. But time and again, Slovenia has risen to the challenge and excelled. It has become an integral part of European value chains, with intra-EU trade accounting for over 2/3 of Slovenian exports. It has shown resilience in the face of difficulty. For instance, its economy bounced back from the 2013 crisis to post robust growth rates before the pandemic. And you will correct me if I get that wrong, but I think that what proved crucial was Slovenia's steadfast commitment to its goal as well as its flexibility to travel the journey towards the heart of Europe. So, commitment and flexibility, and those are the two yardsticks that I will apply to two challenging episodes that I have selected that applies to the whole of Europe, indeed, particularly the euro area, and indeed Slovenia, and that we faced only in the last decade. In that period, Europe has faced repeated shocks, each one different. And in this respect, we can sympathize with the words of the great Slovene poet, France Prešeren. Now, I don't have his words in Slovene, I'm sorry for that. But the title of his poem, which is beautiful, is "The man who from fate receives but blow on blow." I hope it rings a bell for some of you. Afraid it's in English. Now, throughout all these challenges, we at the ECB have remained committed always to fulfilling our mandate, whatever the circumstances. But within that mandate, we have also shown the necessary degree of flexibility, and so has Europe. So let us focus with these two, commitment, flexibility in mind, on two episodes. First, the euro area crisis and the long phase of too low inflation that it spawned. And second, more recently, the return of a phase of higher inflation. So let's look at the first one. The great financial crisis, as it is known, and the sovereign debt crisis here in Europe delivered a much greater shock to the euro area than to other major economies. This was so because those crises have revealed and exacerbated the underlying weaknesses in the institutional architecture in the Union. In particular, we saw that a monetary union cannot be stable and a currency truly single with a segmented regime of bank supervision and resolution. After all, most of the money that people use daily in their whereabout is not central money liability, central bank liability, it is commercial bank deposits issued by commercial banks. And in this setting, if financial markets fragment, it can lead to an asymmetric tightening of financing condition and disrupt the transmission of monetary policy across the euro area. That is exactly what we saw happening as the sovereign debt crisis progressed at the time. But I contend that what helped Europe manage out of that crisis was precisely commitment and flexibility. The ECB's response, announcing outright monetary transactions, OMT, which was the monetary expression of the now famous whatever it takes, underlined its commitment to its mandate by reacting flexibly to the circumstances. This aimed at ensuring the effective transmission to the euro systems of its monetary policy with a view to maintaining price stability. In parallel, the response from Europe's leaders underscored also their commitment to the euro by launching the banking union plan, including in particular banking supervision and resolution. And this was probably the most significant transfer of authority and powers to the European level since the creation of the euro. And I'm delighted to salute Andrea Enria, who is head of the SSM, who is with us today. But the length and depth of the crisis left deep scars on the euro area economy and set the stage for a long phase of too low inflation to emerge as a result. The double hit of the great financial crisis and the sovereign debt crisis left behind a persistent shortfall in demand and employment. From the onset of the great financial crisis, it took 7 years for the euro area GDP to return to its pre-crisis level and almost 12 years for unemployment to do the same. In Slovenia, those figures were 9 and 11 years respectively. Better. This environment that I have just described dragged down inflation in 3 interlocking ways. First, it created a lingering negative demand shock which depressed inflation dynamics. Second, interest rates began to approach their effective lower bound, reducing the space to counter that shock through further rate cuts. And third, inflation expectations began drifting downwards, leading to higher real interest rates at a time when the economy needed policy easing. In other words, there was a real risk of becoming stuck in a low inflation trap. And although the nature of the challenges have changed, it was again commitment and flexibility that mattered in tackling this risk of being trapped. With signs that inflation expectations were starting to de-anchor, the ECB had to show that it was as committed to fighting deflationary forces as it was, and as it is, committed to fighting inflationary forces. Added to which, as the lower bound neared and conventional policy became more restrained, it was key to show that monetary policy could design new unconventional tools to increase its policy space. And the ECB did both, and its reaction was effective in lifting both growth and inflation. But when the pandemic arrived, our degree of commitment and flexibility were really put to the test. Not only did the pandemic deliver a major shock to demand, with potentially deflationary consequences. Remember, consumption in the euro area contracted by 16.5% in just a few months. But it also had strong asymmetric effects on countries that, for instance, relied heavily on tourism as opposed to industry. And this revived the danger of financial instability and impaired monetary policy transmission. So what did we do? We tried to harness everything that we had learned over the previous decade about how to respond to large demand shock in a still incomplete monetary union. Banking union is well advanced, not yet completed. And we have to deal collectively with 19 finance ministers, don't we? So our answers was to launch the Pandemic Emergency Purchase Programme with two functions. Expand our policy stance, but also secure its transmission in all parts of the euro area. What was known as the PEP quickly embodied my message at the time that there was no limit to our commitment to the euro. And it contained an unprecedented degree of flexibility over time, across asset classes and amongst jurisdictions, commensurate with the unprecedented risks to price stability that we faced at the time. That message was reinforced by the EU leaders' commitment, and the Next Generation EU Fund provided a series of first in Europe, first on grants, first on borrowing jointly, and that sent also an unambiguous signal to the world. We saw it in yields and spreads almost instantly. The success of this joint approach laid the groundwork for a much faster recovery than in previous crises. Euro area GDP returned to its pre-crisis level at the end of last year. It took less than 2 years, when it had taken much longer for the previous one. Slovenia did even better than that, actually. The fact that we were able to preserve demand so well has in some ways led to the second challenging episode, the return of a phase of higher inflation. In less than a year, the economic landscape has changed markedly. The unusually fast rebound in demand, this recovery that we saw galloping, was met with a surprisingly sluggish recovery in supply. We paid the price of the just-in-time. Production took time to come back online after lockdowns, and this caused shortages, supply chain disruptions, which have translated into surging energy, food, and industrial goods production. and inflation. In addition, the Russia-Ukraine war has exacerbated all the main drivers of inflation, while also, as a classic supply shock, increasing economic uncertainty and clouding the growth outlook. This has even further complicated the situation facing monetary policy, since in the near term, inflation and growth are moving in opposite direction. Inflation up, growth down. The ECB's initial response was governed by our new monetary policy strategy, which calls for patience and persistence when exiting a long period of too low inflation. But since December of last year, we have started moving down the path of gradual policy normalization. Why? Well, to begin with, the medium-term inflation outlook is changing. Measures of underlying inflation, including those that capture persistence, are nearly all above 2%. Inflation expectations are also at or above 2%, according to a range of measures. And our inflation projections are increasingly pointing towards inflation being at least on target over the medium term. In parallel, the war is likely to accelerate two ongoing structural changes, which during the transition they entail could lead to further negative supply shocks and cost pressure as a result. First, as I argued recently, the war may prove to be a tipping point, causing geopolitics to become more important to the structure of global supply chains. And this will not necessarily imply deglobalization. But international firms will still face strong incentive to organize production, and they will continue to be very concerned about the level of cost and where it will be the lowest. But it might also restrict the perimeter in which they can do so. Second, the war is likely to speed up the green transition as a means of reducing dependence on hostile actors. Indeed, the path to achieving energy security and climate security now point firmly in the same direction. And this is likely to keep up pressure not only on fossil fuel prices, but also on demand for some of the metals and minerals that are already in short supply and yet necessary in order to move towards this green energy that we aspire to. So in this context, it looks increasingly unlikely that the disinflationary dynamics of the past decade will return anytime soon. As a result, it is appropriate for policy to return to more normal settings. At the same time, we do not have excess aggregate demand in the euro area. Consumption and investment are still both below their pre-crisis levels. And the war is creating a challenge for monetary policy by tempering growth rates and pushing up inflation further. So I contend that in such an environment, yet again, commitment and flexibility will both be key. With inflation likely to remain high for some time, actions that demonstrate our commitment to price stability will be critical to anchor inflation expectations and contain second-round effects. This will help ensure that inflation returns to 2% once the various supply shocks have passed. In addition, the ECB has consistently emphasized the optionality in its monetary policy, which creates space for us to respond to inflation surprises in a timely and efficient manner. Faced with uncertainty about growth, gradualism and flexibility will remain important. Gradualism concerning the pace of monetary policy adjustment, and flexibility to ensure the smooth transmission of our monetary policy as needed. The Governing Council decisions in April reflect these characteristics, while also providing a clearly defined sequence of events for the normalization process. First, we end net purchases under the asset purchase program. And judging by the incoming data, and subject to what will be confirmed in short order when we have our projection, my expectation is that they should be concluded early in the third quarter. The first rate hike, informed by the ECB forward guidance on the interest rates, will take place sometime after the end of net asset purchases. We have not yet precisely defined the notion of sometime, deliberately so. But I have been very clear that this could also include a period of only a few weeks. After the first rate hike, the normalization process will be gradual, and I'm deliberately using the term normalization and not tightening. I will explain that more clearly at a subsequent speech, maybe in Sintra. That would be the good time to discuss that. But let me conclude. In Presciren's poem that I mentioned earlier, the protagonist finds no peace from worries on his road, though to the farthest place his search may lead. I think this is a feeling that we can all relate occasionally. But Europe should take comfort and courage and decisiveness from the direction taken by Slovenia, following its independence and the result it has achieved along the way. And the Central Bank of Slovenia had a lot to do with that. The road traveled has been a difficult one, and the challenges we still face together are many. But I have every confidence that we will overcome those challenges. The ECB's action over the last decade should leave no doubt about our commitment to the euro and to our mandate in all circumstances. And just as the ECB has shown commitment and flexibility, so too have Europe leaders and parliamentarians. Each of the shocks that I have mentioned has left us stronger, not weaker, because we have acted decisively to close the gaps they have revealed. Indeed, Jean Monnet's famous line, because we are celebrating the 9th of May, Europe, his line that Europe will be forged in crisis remain as true as ever. So I'm convinced that whatever comes our way, we will find the right response for it and continue seizing the moments of opportunity that such crises ultimately provide. And after 30 years of achievements, the Central Bank of Slovenia will be around to respond to those challenges. So on this occasion, and apologies for my terrible pronunciation, čestitke za 30 let. Thank you very much.
Dobar dan. First, I would like to welcome you to the part one of the conference celebrating the 30th anniversary of the Bank of Slovenia. I would like to thank Governor Boštjan Vasle and his staff for organizing this very special conference and for inviting me. As a Slovene, this is a very special moment for me. 30 years ago, when this was beginning, this experiment was beginning, I was in graduate school in New York. Having left Slovenia, which was then part of Yugoslavia more than 10 years before. And although most of my professional career was spent in the United States, I followed closely the developments of challenges, hiccups, and also great successes that Slovenia, with the Bank of Slovenia, made during these last 30 years. And it's with great pleasure and great pride that I can wish the Bank of Slovenia the governor, and all of his staff a very happy 30th birthday. Part one of the program is going to be a bit of a retrospective. We're going to dive into some of the details that Madame Lagarde so eloquently touched on. I'm going to go in a little bit of this. We have a very distinguished panel that will discuss these issues in more detail. But to start us off, we have a keynote speaker who is very well poised to provide a great background. We have Alfred Kammer, who is a director of the European Department at the International Monetary Fund, and he will give an opening remarks, and then through them we follow by a round table with a very distinguished group of panelists that I will choose later. Alfred, the floor is yours, please.
Thank you. Ladies and gentlemen, it's a great pleasure for me to be here to celebrate with you the 30th anniversary of Banka Slovenije. Strong institutions make for good policy making. Congratulations, Governor. I will leave a discussion of the history of money in Slovenia to the Czech Republic and Croatia, to the expert panelists of our first roundtable. I will try to take a broader perspective. First, I will flag two familiar global trends that fundamentally affect policymaking in advanced economies, along with two internal trends in the euro area. I will then discuss euro area policies, where I will stress the centrality of monetary fiscal coordination. Weaving in the architecture, my overarching point will be that policies at the national and union levels are complements, not substitutes. I will argue that a virtual circle is within Europe's reach. Let me start with two global trends. The first is the balance of supply and demand for savings, which has steadily pushed down the neutral real rate of interest and eroded monetary policy space. Drivers have included a growing supply of savings linked to population aging and subdued demand for savings as productivity growth in advanced economies has seen a trend decline and the capital intensity of production has fallen. As the neutral rate fell, public debt generally increased. The average gross public debt ratio of the 12 founding members of the euro area, for instance, rose from 60% of GDP in 1991 to nearly 100% in 2021. The resulting increase in fiscal vulnerabilities has been offset by a second and related trend that I would like to emphasize. Interest rates have generally fallen by more than growth rates. With this, the average interest bill of the 12 original euro adopters fell from 5% of GDP to 1.5% of GDP over the last 30 years, making it easier to shoulder large public debt burdens. But there are forces that could reverse this helpful trend, including drivers of deglobalization and large investment needs associated with the green transition. Let me next briefly survey two trends within the euro area. A natural place to start is income convergence. While this is not strictly necessary for the smooth functioning of a monetary union, it is the glue for social and political cohesion. Among the 12 original euro adopters, per capita incomes converged in the 3 decades before signing of the Maastricht Treaty. Convergence then slowed before stalling in the first decade of the euro. Following the global financial crisis, per capita incomes began to diverge, unwinding much progress previously seen. Outcomes were better for newer euro area members, but there too the pace slowed. In many respects, the global financial crisis proved a turning point. By triggering a reversal of north-south capital flows, it helped precipitate the euro area debt crisis. A second internal trend concerned the synchronization of business cycles. This, more than the income convergence, is central to the functioning of a monetary union. It determines the appropriateness of the single monetary policy for each member country. Here, the early years of the euro were good. For the 12 original euro members, concordance measures, whether countries are in the same phase of the cycle at the same time, were high at the launch of the euro, and they increased until the global financial crisis. Equally, the amplitude gap, the difference in the size of fluctuations in national growth rates over the cycle, they continue to narrow. Again, the global financial crisis turned the tide. While the concordance of business cycles continued to increase, differences in amplitudes began to widen. In other words, while the common monetary policy still pulled in the right direction overall, the optimal degree of tightness or looseness of monetary settings over the cycle began to diverge across countries. And now to the policy implications. The issue of national specificities naturally takes me to the topic of fiscal space. To the extent that business cycles are less than perfectly harmonized across countries, and in the absence of a central fiscal stabilization capacity, being in a monetary union places a greater burden on national fiscal policy to act countercyclically. Countries need prudent policies in good time to ensure that they have the fiscal space they need in bad times. Alas, what we saw in some cases was quite the opposite. Having failed to capitalize on periods of relatively strong growth, or indeed to have reined in undue risk-taking in the financial sector, several euro area countries found themselves with little fiscal space when shocks struck. Adverse market dynamics then pushed several countries into pro-cyclical fiscal tightening. At the level of the currency union, this widened the business cycle amplitude gap at a time when the effectiveness of monetary policy was beginning to decrease as rates pushed down to the lower bound. Today, in the wake of Europe's strong policy response to the COVID-19 pandemic, there is no way from getting away from the fact that in many countries, public debt has ratcheted up once more. Against this background, let me turn to monetary policy. This is, after all, a gathering of central bankers. We have seen four major crises in the span of less than 15 years. Heightened uncertainty suggests that tinkering around the edges of business cycles is no longer a robust strategy for monetary policy. This is especially true given the low neutral rate, which in effect means conventional monetary policy space is constrained. When the time comes for central banks to respond in the next crisis, they will probably again see a narrow corridor for policy rates hemmed between a low neutral rate and the effective lower bound. The implication, of course, is that we should expect once unconventional monetary policy tool to become increasingly conventional. And in an environment with less monetary policy space, monetary policy needs to be agile in all stages of the business cycle, especially at times of sudden large shocks. Among the major central banks, the ECB remains unique in that it operates in a currency union that is not a fiscal union. Careful lines have had to be drawn between policies aimed at delivering a certain stimulus for the union as a whole, on the one hand, and policies to ensure proper policy transmission to all corners of the union on the other. The ECB has proven to be a learning institution, adapting well to uncharted territory. Today, of course, the challenge is too high, not too low inflation. Policymakers and market participants agree that the time for policy rate liftoff in the euro area is fast approaching. If policy is not agile enough, inflation expectations risk becoming unanchored, which would likely demand a higher and more economically costly peak policy rate. In such a world, the challenges of the lower bound and the need for monetary space might fade from memory. If policy is too assertive, inflation could be knocked back into its below target equilibrium of the last decade, with all the negative implications for future monetary policy space. At times like these, data dependence is critical, but more to that in the second session of today's conference. Now, let me bring this all together and touch on an issue that is one we neglect at our peril: monetary fiscal coordination. As I discussed earlier, cyclical differences in national fiscal policies have contributed to diverging business cycle amplitudes across the euro area. This divergence, coupled with scarce monetary and fiscal policy space in some countries, means policy coordination must receive higher priority at both the national and union levels than in the past. In essence, I'm underscoring that monetary policy cannot do it alone. In the context of a monetary union, different degrees of fiscal space can and do complicate monetary policy making. The impact of common shocks can be asymmetric across countries, especially if limited fiscal space gives rise to pro-cyclical budgetary policies. This reduces the potency of monetary policy easing in the more vulnerable countries, and it also complicates decisions to tighten monetary policy lest they destabilize some domestic credit markets. Cyclical incongruence with monetary policy settings can also place higher demands on national budgets. At the national level, as I noted, where deficits and debt are high, there is a need for fiscal policies to focus on rebuilding fiscal space. This makes it all the more critical for countries to improve the composition, quality, and overall design of their fiscal policies, including to help lift growth. And fiscal consolidation and reprioritization must be complemented by structural reforms to reduce competitiveness gaps across countries and thereby facilitating convergence and enhancing policy transmission. Finally, architecture has a crucial role to play in squaring the circle. At a high level, more progress on risk reduction and improving economic resilience at the national level would help build political support for a stronger shared architecture, which in turn would further reduce risks and enhance the impact of national reforms. Many steps to shore up the architectures have been taken since the global financial crisis, including erecting key pillars of the banking union. I always think of the single supervisory mechanism, a formidable system of Euro banking supervision that did not exist a decade ago. But the efforts are far from complete. Perhaps the biggest missing piece is a permanent central fiscal capacity for macroeconomic stabilization. A well-designed fiscal stabilization instrument combined with a needed reform of the fiscal rules would help counter the tendency towards pro-cyclical fiscal policy at the national level and thus support a better monetary fiscal mix. It would also help narrow the differences in the amplitude of business cycles across euro area countries, making the common monetary policy a better fit for all participating member states. Of course, here as in other areas, a key roadblock is fears of moral hazard. Let me conclude by emphasizing 2 points. First, monetary fiscal coordination must receive higher priority at both the national and union levels, and doubly so in an environment of constrained policy space and high uncertainty. Monetary policy needs to be agile in all stages of the business cycle, and with less than perfectly harmonized cycles across countries, it cannot do it alone. Fiscal policy must play its part, and to support economic activity in bad times, space must be created in good times. Having a central fiscal stabilization capacity in the euro area would help greatly in this endeavor. Second, the experience of the pandemic has shown us that depending on the challenge faced and given appropriate policy design, solidarity can overcome fears of moral hazard. During the pandemic, monetary and fiscal policies worked in tandem. The political agreement on Next Generation EU was a watershed, and one that should help boost productivity and growth in the medium term. Lessons should be applied to addressing remaining weaknesses in the architecture to help narrow the divide between risk sharing and risk reduction. Finally, let us always remember that a rising tide lifts all boats. Growth makes it easier for countries to reduce fiscal vulnerabilities. Stronger fiscal positions, coupled with reforms to boost potential growth, encourage more cross-border investment and private risk sharing. That improves business cycle synchronization, making monetary policy more effective, and it promotes income convergence. And convergence ultimately is the glue for social and political cohesion in the Union. Europe faces grave challenges emanating from the war in Ukraine, but the solidarity, creativity, and boldness with which it has acted in the last 2 years make me believe a virtual circle of mutually reinforcing national and union-level reforms to raise growth and make Europe more resilient is possible. Policymakers should seize this opportunity. Thank you.
Thank you, Alfred. That was very, very thoughtful remarks, a lot of food for thought. Before we move to the second part of Roundtable, I was asked by the conference organizers to inform you that Madame Lagarde has pressing business to attend, and as a result, she will not be able to. You may stay for another 10 minutes? Oh, okay. So please know that when she leaves, it's because of very, very important reasons. Thank you very much. So with that, that was a great introduction to start us off, to dive into some of the nitty-gritty details of what was happening over the past 30 years. So I would like to start by inviting the members of the Roundtable to come and join me here on stage. So the Roundtable, we have 3 participants who are well poised to speak on a variety of issues that we're going to tackle today. First, we have Boris Vujčić, who is the governor of the Central Bank of Croatia. Please, Boris, if you can come up. We have Tina Žumer, a relatively new addition to the Bank of Slovenia, who is a vice governor. Tina, please, if you could come up and join us. And also, we have Vojtech Benda, who is a board member of the Czech National Bank. Vojtech, if you could please. Great. In terms of the way the Roundtable is going to work is it's meant to be a discussion, though it's somewhat scripted, of course. We have some questions that we have sent to the participants before that they're going to touch on. They're going to comment on it. I would encourage them to also jump into the discussion, and hopefully, if the time permits, we would at the end maybe have 5, possibly 10 minutes for the questions from the audience, if there are any. Okay, great, thank you. Okay, is this on? Yes, it is on, all right. Okay, so our job is to travel, to go back and reminisce, to fill in the blanks, right, in so many ways. So, going to the beginning, right, the Bible starts, let there be light, right? But in monetary economics, perhaps the better question is, let there be an exchange rate. That's how things start. And especially that's how it started for all the 3 countries represented here. So that started with the political independence of Slovenia and Croatia when they declared independence from Yugoslavia. Also with the Czech Republic after dissolution or the Velvet Divorce in 1993. All of these countries successfully introduced national currencies. Now, obviously, the introduction of a national currency is complicated. You have to consider a variety of issues. So to start at the beginning, the question I have is, what affected the initial choice of fixed float, or more generally the exchange rate regime that was adopted? And could you reflect on some of these decisions? And maybe we can start with Wojtek, you as a first person.
Yeah, well, thank you. Good morning, and I also would like to say I'm very grateful for the invitation for this decent event, and congratulations on the 30-year anniversary. So great success, and I think all the CEE countries joined very similar experience, like transformation of the economy from the central plant with the regime of currency which is not convertible or just is virtually convertible via convertible ruble, as it was before 1990 in our case. And of course, in this situation, when you are starting from scratch, it's very difficult to decide how to set the regime. And each country, I think, was choosing very similar ways, but of course, respecting the national and economic specialties. And the same was also the case of the Czechoslovakia and later Czech Republic, because first of all, the country or the government and the central bank realized that the currency and the official exchange rate doesn't match to the reality. And so it was very difficult to find a new parity against the other currencies of inconvertible currency. And actually I had a great luck, because in 97 I was doing my thesis, and it was about the establishment of the exchange rate regime. I still caught the people in the bank who were in the process, because they are not there anymore and there are not many tracks left behind. So unofficially, I can say, or unofficially for such a big audience, one of the main indicator for the setting was black market exchange rate, because the money that were exchanged on the black market was probably representing a sort of a real exchange rate or a real nominal exchange rate. And of course, in addition, there was no information and figures about productivity differentials, and the price level was artificial and had to be liberalized and so on. So finally, it was set some discretionary exchange rate against the US dollar and the D-mark. It was established fixed exchange rate against the basket, where 65% was represented by D-mark as the biggest potential trading partner. The rest was US dollar. It was set very narrow tolerance band for the fluctuation, only 0.5%. And before, of course, came the fourth-step devaluation of the currency. And it turned out that in fact, given that the fixed exchange rate lasted and stayed at until 1998, it seemed that the parity was set relatively well. And of course, the devaluation created a cushion for the corporates, for the Czech companies, to get some competitive advantage and to be competitive in prices and exports, because it was very important in a period of economic transformation and restructuring of the economy. At the same time, it would not work without imposed capital flow controls so that there was only limited convertibility of the currency. And since 1993, when this model was set, the monetary policy of the Czech Central Bank was, the mandate was currency stability, or the currency stability, which in fact embraced two targets, so price stability and the stability of the currency of the exchange rate of the koruna. Gradually, the cushion was deflated because the price level was, or the wages and the economy was growing faster than the Western counterparts. And in addition, there was a relatively strict fiscal discipline, became more relaxed during until 1995. And at the same time, of course, they were gradually lifted off the capital flow controls. And so at the moment, there was a sign that this regime is unsustainable for longer, because it bumped into the problem of the impossible trinity. The impossible trinity means that you cannot maintain at the same time fixed exchange rate, independent monetary policy, and liberalized current account and the financial account of the balance of payments. The monetary policy so far was the German model. It was targeting the money supply approximated by M2 aggregate. It also turned out that it's not sustainable anymore. So when the pressure for the outflow of money, outflow of capital came, the central bank left this regime, and in 1998 established the inflation targeting. So we were the first CE country which actually started with this regime. Of course, it was modified compared to the New Zealand and Bank of England model, because a lot of prices were regulated by government. There were administered prices for living, for heating, for energy, electricity, and so on. And those prices were gradually liberalized, and it, of course, it was resulting in increase of prices. And the central bank didn't want to react on this because it would not be the goal of the central bank. So the first target was set that we switched to inflation targeting, and a fixed regime went to managed float. So the central bank since then doesn't have any specific target for the exchange rate. The only episode was between 2013 and 2017, when the central bank already exploited the main instrument, which is interest rate. We reached the technical zero levels, close to zero, and we didn't see, or the central bank didn't see, a big point to come to the negative territory. And the QE regime, similar to Fed, was not appropriate for the situation in the Czech economy. So the central bank finally decided to choose the FX regime instrument. So it was forced weakening to currency to some specific level. In that case, this was 27 against euro. And there was strong commitment, and there was set commitment that the central bank will keep this level, the currency above or close to the level, but not below, until the deflationary risk would dissipate. And of course, originally it was thought that this regime could last only 1 year. It lasted 3 years because there was permanent surprise on the downside from the prices of the Eurozone. But this regime is left already, and we are already in a managed float as regularly.
Great, thank you. So I remember, I would like to hear a little bit, because in the early 1990s, coming back home from United States, having Slovenian dollars was a very new experience. And I also remember in those years there was a considerable degree of sort of a currency instability in Slovenia in the early years. So maybe, Tina, can you reflect a little bit on how the Bank of Slovenia managed that initial bout of this, because it dissipated very quickly, and it was very quickly dollar became, a stable currency. Also, the adoption of a euro followed relatively quickly. But these initial years were obviously very challenging, and can you maybe add a little color to that for the audience here?
I hope it's on. Yes, thank you. As you said, I'm a relatively recent addition to the Bank of Slovenia, but I did work at the Bank of Slovenia before, but still I needed to dig into this issue myself. I don't remember them by heart, but indeed, so Slovenia, in contrast to most of the other countries, actually adopted the so-called gradual transition. So in that way, it balanced the real and nominal adjustment process throughout the transition. And from the beginning, it opted for the managed floating exchange rate. At the beginning, indeed, the first year, it was relatively more flexible, and then as of, I think, 92, this management of the exchange rate became much more, let's say, frequent. In particular, the Bank of Slovenia was intervening to counter the volatility and the excessive exchange rate appreciation pressures that, of course, then started with the capital inflows coming into the country. So that was then the initial years, and as we heard also for the Czech Republic, it didn't go without imposing then the capital controls in 95 that were then lifted in 99 in the light of the prospects of the EU accession, indeed. So that was, let's say, on the exchange rate, yeah.
Boris,
And that, just to end, that actually it retained the managed exchange rate regime all the way throughout until the euro adoption in 2007. Yeah.
Boris, of course, the situation in Croatia was a bit more complicated, right? There was a war, there was a, and you lived through this. That's I'm looking, like I said to you over the coffee, I look forward to reading your memoirs. So maybe, you know, given this was very different, whereas, you know, the Czech Republic and Slovenia kind of had a common way of establishing their basic, you know, monetary and financial exchange system, you know, Croatia faced a special set of circumstances. Maybe you can briefly, you know, touch on that and add a little bit for the audience. Yeah.
Yeah, as you said, Egon, it was different because we had a war at that time.
Absolutely.
But basically, the issues were very close to what Slovenia had in Czech Republic, also in a different way. The system was a legacy of the Yugoslav economy,
Right.
which was. I usually say it was like a Latin American economy in Europe. If you would lend the Martian economist who doesn't know geography and understands the economics in the
We
world.
should all be speaking Spanish.
And say, yeah, exactly. Where does this country belong to? He would say Latin America, because it had all this. It was not a command economy like on the eastern side of the Iron Curtain, but was kind of self-managed with a partial market economy. However, it was very poorly managed in the 80s and at the beginning before the dissolution of Yugoslavia. So we had these episodes of inflation, hyperinflation, and continuous devaluation before the dissolution of Yugoslavia. And this was in the memory of all people here.
Absolutely, yeah.
So it was all about the exchange rate in the end. Exchange rate played a key role. Of course, these are small open economies where the exchange rate, when it was devalued, had a very high pass-through on the prices. And you had this, I would say, Latin American circles of the devaluations, inflation, etc. So if you wanted to break down with that, you had to do something with the exchange rate that is credible.
Exactly.
And that's what we did actually in the midst of the war in October 1993. And one thing that you learn from that is that when the central bank loses credibility after successive attempts to bring down the inflation, then the government has to kick in. Mm-hmm. And actually in Croatia, it was the government who came out on the TV, the prime minister, and said, now we're changing the monetary regime, and we're introducing the stabilization program. And it was done by the one of devaluation and then fixing the exchange rate.
Right.
Which worked well.
Yeah, it did. Yeah.
But one has to have in mind that the credibility issue is very important.
Yeah, that's right.
Second thing, if you think about the inflation dynamics, when we did the stabilization program during the war, the inflation rate was ranging at 30% per month. So much higher than what we have today, so very different than we have today. But you can still see, because there were lots of attempts in Yugoslavia and in Croatia up until 93, when finally we succeeded, of stabilizing the inflation and the exchange rate, and then it would start to creep up and go up. So you can learn about the nonlinearities. So it's clearly nonlinear.
Right.
As long as the inflation rate is low, exchange rate is stable, it's fine.
Exactly.
Once it starts to go up, it's very difficult to say where the tipping point is, but it's nonlinear. And I guess in the different circumstances, tipping points are in the different places.
Absolutely.
It's path dependent, depends on the history, on the way that people form the expectations. So today is much better because we've had a long period of a stable inflation, stable exchange rate, so probably tipping point is higher. But we have to have in mind that I saw it, this is how it happens. Once you lose the control, it's very difficult to regain the control. You have to really do...
It's very costly.
It's very costly.
In terms of output
you have
and
to
employment.
Really pull up the brake, you have to slow down the economy. There's no other way. Now, we can all think about the different circumstances today or then in terms of when the non-linearities kick in and how they affect the credibility of the central bank. I remember when I was a young economist, like short pants.
Still young economist.
Still economist, yeah.
Still young economist.
Thank you.
You're just better dressed now. You're just better dressed
but
now.
Young economist sounds even better. Vojtech has been always very kind to me. I sat at the BIS meeting with Greenspan. So it was like a 2000-2001, Mexico City, bi-monthly meeting. And so, Greenspan was at that point.
The maestro.
Yeah, maestro. Can I ask you a question? I said, yeah. When do you think the inflation really becomes very dangerous? At which point we should not let it pass, which is the tipping point for the non-linearities? And he went, 5%. Like this, 5% kid. Okay, because all the evidence shows that when it passes the 5% non-linearity, so it's going to become, so all these arguments. So, okay, good. And this is really where the literature was. Stanley Fischer and others were showing it's usually around the 5%. And then I asked him, and what on the downside? This was way before the deflation issues and the low inflation. And then he paused and said, well, I don't know. This is much more difficult to say. Absolutely. We don't have too many historical examples of a low inflation or a deflation. And actually, there's only one where it proved to be costly, and this is the Great Depression.
Exactly.
When the expectations set in a negative spiral. Well, for example, in the US, second half of the 19th century, you had a deflation and fantastic growth. This was the highest growth in the history of the US. Why? Because the productivity growth was high.
Absolutely.
So as long as you have a high productivity growth, you don't worry about the low inflation. You worry about the high inflation.
Yep.
And now we're in a different... The world has changed, as Christine said.
Exactly.
The super cycle of high productivity growth of China and other emerging markets is done. Globalization positive effects are gone. So we should start to think about inflation.
Absolutely.
We're going because the world is a large closed economy. And we should think of it as a large closed economy. That would be my take-up from a bit of a history that I learned.
That's right. That's, actually, that's a wonderful segue to the next question, which I wanted to kind of set up a little bit. So there it is. This is it, the beast that we're all talking about. So this shows the inflation rates for Croatia, Czech Republic, and Slovenia. And, if you see up here, I cut everything at 40%. Because if I actually put the actual realized inflation rate, it would just look like a big vertical drop and you could not see any variation, okay? And so you can see, how successful and just how it is. So the question I have, and I will start with you, Tina, is that, this is obviously a very destabilizing, destabilizing monetary conditions with this kind of inflation rates. How did Slovenia, what were the key principles that Slovenia used, to bring down the inflation that was above 40% at year over year, in a relatively quick succession down to very, very stable, level?
So, as I said earlier, Slovenia adopted the managed floating exchange rate regime. The reason being also that it had no reserves and coming from the hyperinflation, so more thousands
in the
Yugoslavian times, exactly. Right. And then, of course, the primary concern for the monetary policy was to bring down the inflation, which it did in the context of the money-based stabilization. Okay. So actually it followed some form of money targeting, cutting the nominal supply of money, first the narrow aggregates and then later on broader like the Bundesbank did at the time. Indeed. And then when inflation was coming down, this enabled the Banka Slovenije also to reduce gradually its nominal interest rates primarily on the liquidity absorbing instruments. And at the same time, it kept relatively high real interest rates. This had further contributing then to this inflation process. As I said before, the interventions in the exchange rate markets have been also present all the time. But then let me say a couple of words on this blimps that you see around 2001 for Slovenia. That was also a very interesting period that I will also maybe mention later from some lessons learned. So basically, this disinflation process was then interrupted in '99. That was due to the external supply side factors as well as demand side. So Slovenia at that time introduced the VAT that pushed prices high over the night, more or less. In addition, we were facing also an oil price shock and very strong domestic demand. Basically, overheating of the economy, private consumption was growing high, spurred by credit growth that really took off at the time, and high wage increases. Another point that I will come back later, as these wage increases at the time automatically responded to inflation shocks. At the same time, important institutional changes happened, namely the EU accession process has progressed to the extent that we knew that Slovenia will be among the first countries and soon to enter the EU. And then the new Bank of Slovenia law was adopted, enshrining price stability as a primary objective. And in this context, also the Bank of Slovenia introduced a new monetary policy framework, which could be best described as some form of inflation targeting within still continuing managed float. And what was really key at that time was what we heard from the Madam President before and Boris. It's really this commitment to the euro adoption and the credibility that was imposed through this channel on the monetary policy and helping to bring the inflation expectations to this entry point, basically the inflation rate that was consistent with the Maastricht criterion to meet this inflation as soon as possible, which meant in the, let's say, around 2005.
Wojtek, I'm going to put you a little bit on the spot. So, you know, the Czech Republic was also very successful in disinflating, but now that I'm looking at the graph, something in a sort of first half of the 1990s, there's a big increase in inflation. Maybe, I don't know if you remember that from that is, but maybe you can kind of touch on some of the experience of the Czech Republic of this massive disinflationary episode.
Well, usually when we speak about our past inflation targeting, we were always like a little bit posh, that look at the low inflationary environment and so on. Yeah. It's better now when you look at the recent development of the inflation. And of course, even in the bank board, there is a similar split like between Fed and ECB. Like we mostly say, of course, there are the external shocks in the inflation reflected now that we cannot control, and we should expel, or we should use the exemption from the rule, like the commodity prices, energy prices, and so on. But if you look at the period between 2018 and 2021, so already in the pre-COVID period, the Czech inflation started to soar or to increase to about the inflation target, and one of the explanation is the tightening of the labor market. So the labor force is completely depleted. We have the lowest unemployment rate in the EU, so below 3%. There is the participation rate already increased to maximum level it can, so there is no much scope for a further increase of support for labor creation by participation rate. And the wages performed, the growth was relatively hefty during the recent 5 years, fairly above the level of the EU. And so it was supported also relatively weak, relatively soft monetary policy during this period. And the COVID actually, everybody, I don't know many economists who were right in the beginning about the impact of the COVID. So many were thinking it's a demand shock, but it turned out it's more than that, it's a supply side shock. So decrease of potential, at the same time the economies flooded with the fiscal transfers and so on. So it created some bubble that already also exaggerated this problem and increased the pressure on inflation. And I think when you look at we have relatively low indebtedness of the state, but we have one of the biggest increases during the 2020 and 21. So the fiscal theory regarding the debt burden to inflation actually says that it's important how quickly you are able to reduce the fiscal deficit, and we are among the countries where the fiscal reduction didn't come, so the increase was relatively hefty. I think that's also attributable to the increase of inflation.
Of course, of course.
And we started to hike the rates in the mid-2021 and a relatively hefty pace. Then the other regional peers like Polacks and Hungarians were following us. But I think we started a little bit late. But it's difficult to start tightening when still the country is under lockdown.
Of course.
Because nobody believes you that you are not that you start tightening when ECB says it's still time to be relatively open for the monetary stimulus. So I think we will be able to tame inflation, but we already said last week when we had a monetary policy meeting after that in the statement that it's now time to think about the temporary extension of the monetary policy horizon, because the shocks from the commodity prices will last for longer and will keep the inflation above the target for longer. And the reduction or a monetary policy tightening in this situation, which would respect it fully, would be maybe too harmful for the economy recovery. So.
Right. I think this is very true for monetary policy makers. This is such an unusual time, right? And if you just look at this last period, and this is a point Madame Lagarde made, suddenly the past 10 years, right, you've had inflation below the target globally, right? And it was not just the ECB that struggled with trying to bring inflation with target. The Fed, my own employer, was consistently below the target, right, since the global financial crisis. But now, right, we're observing numbers that are above the magical point of 5% that Boris brought up earlier. So, Boris, to you. So, obviously, as Vojtech pointed out, the reasons for high inflations are obviously very different right now, right? We had a supply shock, to the COVID pandemic. We had a rotation of demand because of lockdowns from services to goods, particularly durable goods, right? And so forth. There was a enormous fiscal impulse. We have a sequence of energy, commodity, food price shocks, which are obviously, immediately coming up. So there are very different reasons than what was happening, in the early 1990s. Nevertheless, do you see, some parallels and things like that? What are the lessons, that we could draw from the earlier years that we should be applying now, thinking about that?
I think that basically inflation, it's very different, but basically inflation is always a consequence of some disease in the economy. The inflation that we had at that time was there because the economy was not functioning well, both at the beginning of 90s, because there was a huge problem also with the war, but also with the macroeconomic policy management, which was leftover from Yugoslavia times. And in Yugoslavia, if you look, for example, at the time when the productivity growth was high and the GDP growth was high in the 60s and first half of the 70s, 50s, 60s, the inflation rate was low.
Right.
And then when you have the problems in the real economy, one way or the other, whether you are a closed economy, so only internal problems, or you're open economy, and then you import the inflation as you do now, there is some disease somewhere. Disease today probably you can call has been introduced by a disease, a virus first, breakdown of the supply chains, and then the war, which is another disease.
Exactly.
And this is reflected in the inflation. So inflation is in a way always a symptom of some problem. The problem is it can become a problem in itself when it de-anchors.
Absolutely.
For example, what you can learn from the past, which you asked, is the inflation rate of 30% per month was not a consequence of a demand-supply problem.
Yeah, purely monetary phenomenon.
It cannot be. It's a pure monetary phenomenon.
Absolutely.
So this is what we can learn. You know, the initial inflation push is always a consequence of some problem, disease, but then it can become a problem in itself, which you have to cure with a very sometimes unorthodox, heavy artillery, and this is what we had to do. When you have 30% inflation per month, obviously it's not the excess demand thing.
Yeah. Tina, you brought up an interesting point that might be relevant in talking about the inflationary dynamics of the early 1990s during the transition to a market system. You pointed out the direct link between prices and wages. That the price increases were automatically being factored in the wages, which squeeze margins, which cause firms to increase prices, which then get fed back into it, right? And you're in the so-called wage price spiral, the same dynamics that US and other advanced economies experienced during the 1970s, another period of kind of a runaway inflation. To what extent, I mean, obviously labor markets have changed, but, you know, there's significant differences, but nevertheless, one of the kind of key defining characteristics of not the hyperinflationary regimes, as Boris was pointing out, but, you know, inflation that is systematically and persistently above sort of central bank targets in advanced economies, you know, is this wage price spiral. To what extent do you see this potential dynamic taking hold in Slovenia, in particularly right now, and whether or not the risks of that, you know, repeating sort of the policy mistakes, you know, maybe, you know, are maybe there?
Yes, indeed. Maybe let's put me this into, let's say, 3 points that I think are relevant from that experience. I don't want to go back to this really early 90s, but really to this period around 99 to 2002 that resembles a little bit to the situation that we are having now, in the sense that we were hit by some form of external shock. Of course, not that magnitude that we are facing today. But yes, wages is definitely one lesson, and we will see how persistent these inflationary shocks will be through wage dynamics. And in Slovenia at that time, wage indexation was largely automatic, backward looking. So
it was built in the cake in some sense.
Exactly. And then as soon as the inflationary shock hit, inflation started to grow, and that fueled really further this domestic demand and was passed on. So the key element to really start again that disinflation at that time, actually inflation came down from 250 in 92 to single-digit levels in 95. And then it increased again to double-digit levels. So that was a big issue. And to bring that down, it was really key to abolish that automatic backward wage indexation. So it was changed first into more forward-looking, taking into account like future inflation, productivity, and then gradually abolished. So today in Slovenia, as in majority of the euro area countries, we don't have really automatic wage indexations. But however, we do know that in wage demands, inflation is one of the elements. Yeah.
And I think it is important also to note that in real terms, real wages in the euro area have been stagnant, in fact have declined, say, for the past decade or so. And you know, with this inflation, I think the workers have seen a real erosion of the purchasing power that's been has compounded essentially the 10 years of really almost declining real wages. But Vojtech, on your point, you also mentioned that the labor markets in the Czech Republic are very tight. You have sort of lowest unemployment rate. Is there concern that this kind of a wage price dynamics could take hold, or is it very much this sort of a mechanisms that were baked in the cake that could lead to that have largely been abolished in Czech labor markets?
I think it is a concern. That's why also we see the reason and the need to deliver monetary policy tightening. And of course, there are arguments. You will slow down the growth, you will hit the growth, the economy might even go to the temporary to negative territory. But unfortunately, that's the dark side of the monetary policy. So if you want to really slash the inflation pressures, and if you want to keep anchored the monetary the inflation expectations, sometimes you have to slow down the economy and push against the sources of the inflationary pressures. And with the labor market, with depleted labor force, with a relatively hefty growth of wages, at the moment when nominal exchange rate is more or less stable or even appreciates, so in the long term they would hit productivity much worse than the current situation. Of course, there is also the experience from the past. We saw, in fact, unemployment was falling relatively quickly. Exchange rate was strengthening relatively quickly in the period, you have it in the chart as well, between 2002 until 2008. But it was mainly driven by strong productivity growth, and the productivity growth was driven by very strong inflow of FDIs into the economies, all of us, all these economies. These sources are more or less gone. So this model, growing model for Central Eastern European countries, I think reached the end. And now you have to, of course, find a new model for the companies to increase the productivity by more capitalizing, more investment, and some people say smart economy. I personally don't know what does it mean, but I imagine something very sophisticated. And this is a model that unfortunately cannot be forced by the central banks or by governments. It has to come from the ground, and the central bank responsibility is to create a relatively stable environment for everyone. Of course, somebody wants to lower interest rates, the other one wants to have a higher interest rate, somebody wants to have a depreciated currency if they export, somebody wants to appreciating currency, but there must be some average and some redistribution effect between the whole economies, and the stability is important. So the labor market is an issue. Of course, now very actual is the debate about the impact of the inflow of refugees from Ukraine, because they are quite hefty in the countries like Poland, Slovakia, Czechia, and partly also the other countries. But there is no match between the demand of the labor and the supply of the labor, because at the same time, Ukrainian men had to leave the country to fight. So, and there is no match, but in the long term, maybe there will be some positive effect and so on, but of course, I am very cautious in this tragical situation to find some economic advantages in this. But
it's very hard to see that, I agree, yeah. But I think this does underscore a very important point that also Madame Lagarde alluded to in her remarks, which is that, you know, and this is not just true in Europe, maybe perhaps it's more accentuated in Europe, it's true in many cases, that for too long, monetary policy has been the only game in town. And, you know, monetary policy is about macroeconomic stabilization, price stability, financial stability, you know, so as primary mandates. But as Vojtech was pointing out, you know, to deliver sustained economic growth, this is about structural reforms, right? And this is really the fiscal policy, and the a credible, well-run central bank is someone that can establish fertile conditions for this to take place, but then it's ultimately to elected politicians to deliver on that promise. And I think for too long, you know, this has been you know, unfortunately not really going on, and monetary policy has been, you know, called to deliver on all of these goals, which creates a problem. This sort of brings us to another topic that I want to touch on, because it's very important, which is the adoption of the euro. And Boris, you're yeah, congratulations for soon to join the eurozone. Slovenia adopted the euro in 2007. Maybe you can discuss from your perspective, you're clearly committed, there are obvious advantages, otherwise you would not be doing it, but it comes with a cost. We're economists. Everything is a trade-off. There's cost and benefits to everything. So maybe you can touch on how you see, as you're coming in particular, what are the costs and benefits of joining the euro?
Yeah, well, from our point of view, I think that Croatia is the country that will benefit most from the entry into the Eurozone. Why? Because we are already heavily Euroized. So we are more Euroized than any other country at the time of joining the Eurozone. Why is that important? That is important because if you are very much Euroized, and in Slovenia I'm sure everybody would appreciate that, although the level of the Deutschmarkization or Euroization was a bit lower here, that creates a large foreign currency risk that you have to manage and which is costly. To give you a flavor of what we are talking about, all sectors of the economy in Croatia, households, companies, and government, collectively have debt in the amount of equivalent to 123% of the GDP linked to euro.
Oh.
So directly in euro, mostly government bonds or loans indexed into the euro. Why that happens? That happens because of the euroization. Most of the deposits in Croatian banks, savings deposits, term deposits are still in euro. So what the banks have to do, they have to hedge their position. So if they have a liability, they have to hedge it on the asset side, so they link the kuna loan into the euro. That's something which never happened in Czech Republic or Slovakia, but different history.
We are going in the other direction already. So.
Exactly, yeah. And in our case, that creates a large FX risk. Imagine, this is why, of course, our main monetary policy target was not inflation, so we never went to inflation targeting. Why? Because we have to target exchange rate. You cannot do both at the same time. But of course, the exchange rate has also anchored very well inflationary expectations, so you have low inflation as a result, but the target is exchange rate because of the foreign exchange risk. And the calculation is very simple. I argued so many times in Croatia when people were saying we have to devalue to become more competitive. I said, look, you devalue, and the level of debt in your economy goes 12.3% percentage points of GDP up. So your C declines by that much, I declines, and G either go down or the taxes go up.
Right.
So X minus M cannot nearly compensate. So you have a recession.
Yeah.
So the devaluation is recessionary, this situation. And then, if you're in such a situation, then you cannot run independent monetary policy.
Absolutely. Right.
So as Bob Dylan sings, when you got nothing, you got nothing to lose. So why not join the monetary?
I understand. Clearly.
You cannot touch the exchange rate because of the foreign exchange risk. You have to accumulate the foreign exchange reserves. Now it's almost 50% of GDP.
Right.
To make sure that this is very stable. That's costly also.
Absolutely.
So it's much better to do away with that. Once you eliminate this foreign exchange risk, which is huge, interest rate premium goes down, rating goes up, and you don't lose anything because, again, you cannot use of course, there are all other things like the more efficient payment system, trust of the investors. These are positive effects of trade in all models proven, whereby if you have a stable currency, anybody who comes from that area is more likely to invest in your country because you eliminate the foreign exchange risk for them. So if somebody comes with 100 million euro investment in Croatia, 10% depreciation of the currency also shaves off 10% of their investment, 10 million euros. So investment might not be feasible anymore. So these are all positive effects, but the key thing, why it's so important for Croatia is this large euroization and inbuilt foreign currency risk because of the high euroization. And of course you can't touch, and you can't also do anything with the interest rates.
Right.
Because it's impossible trinity, as Mandel nicely explained. No more capital controls, you're part of the subcabinet. You fix the exchange rate, so interest rate is given by, you
exactly.
import the monetary policy of the ECB. If you import the monetary policy of the ECB, why not be member of the ECB?
Precisely.
So for us, it really doesn't make any sense to stay out of the Eurozone.
Right. Yeah, that's this year. Tina, on the other hand, Slovenia has had, now quite 15 years of Euro. There's reflection. We'll touch a little bit. We'll discuss, move on next, about asymmetric shocks and all of those things in a little bit. But nevertheless, I would be curious to hear. So, it's clearly a success. It has anchored Slovenia. It is, it's for many reasons. It is very natural for Slovenia to be part of the Euro system, given its close, ties with the major European economies. But what is, but I think the crisis, particularly the Euro area sovereign debt crisis, did expose certain fissures, right, in the system. Maybe you can reflect on the 15 years of Slovenian adoption of the Euro, the pros, the cons. I mean, of course, I think we would all agree that on net, the benefit was well in the positive territory. But just to have a bit of a debate, what do you think were some of the costs?
Yeah, so indeed, I think that the benefits are well known, joining the monetary union. So I think overall, indeed, adopting the euro was beneficial for Slovenia, no doubt. I would say that the most challenging part was really just after the euro introduction. In 2007, 2008. So while we did import the monetary policy stance like Boris Croatia does, there is still this additional sentiment. The foreign investors perceive you a bit in a different light. Mm-hmm. So I think you get a squeeze in the risk premium, you get new opportunities, but also the environment at that time was a bit different than today. So we were faced by, let's say, investment opportunities by very strong domestic demand. And at that time, the EU, Slovenia was not the only country, so it was the European issue that the EU architecture was not really sufficient to protect the countries in such an environment enough, or let's say it did not motivate really to build up the resilience to shock and to this shock absorption capacity. So I think that since then we have learned, and there were improvements, changes in the EU architecture. So I think these challenges have been mitigated. We have much more EU coordination of the policies at the European level. So we have, for instance, the European semester monitoring European domestic economic policies beyond the fiscal policy. Then we have the banking union, though still not complete, but being part of the common supervision and common resolution is definitely mitigating this. So we also have macroprudential policies. I think this is something that is, let's say, very important instrument that remains in the hands of the national central banks. It's coordinated at the EU level, but we at the Bank of Slovenia, we have learned from the banking crisis how important it is to monitor the financial cycles and build up the resilience of the banking system, and therefore we have been using these macroprudential instruments. Mm-hmm. So this is, let's say, let's leave it here. Thank you.
Wojtek, you, Czech Republic is a different member of this. You have thoughts on this. It will be very interesting to hear your perspective. As somebody who's very integrated into the European business cycle, into European cycles, yet you don't have you seem to also face the Eurozation, as Boris was pointing out. How are you viewing that, the process, the costs and benefits of joining the Euro?
Well, this is a good question, actually. The debate about Euro adoption in Czech, we said, so far it was like underwater river. So it goes underground river. So it goes underground and sometimes it appears on the surface and then it disappears again. Right. So
like Ljubljana.
And it fluctuates with the currency depreciation, appreciation, and with the change of the interest rate. So I think until the Czechs were benefiting from low inflation environment, low interest rates, sometimes lower than in the Eurozone, and relatively stable and gradually appreciating currency, everybody was fine. But in the situation when currency lost the momentum for appreciation because you don't have such a strong surplus in productivity as you had in the previous decades, and in fact the country is now experiencing much higher interest rates than the Eurozone. Of course, the debate is vivid again. So the dollarization, in our case, like we have like 37-38% of the credit of the loan of the corporate sector in euros and in other currencies, but this is more like a natural hedging of those who export, and instead of hedging and paying the options and so on, they naturally hedge.
Right.
But of course, now they complain that the interest rates are too high, and it adds to the costs of the energy prices and the previous and the current growth of wages. And in fact, the central banks like pushing on the corporate sector, and the debate about the euro adoption is vivid again. But of course, this is something that cannot be initiated by the central bank. We are an agency that is according to the law and everything.
Absolutely, right. It's a political decision, ultimately.
We only, so there has to be political decision. There was like some attempt of the current coalition to come with a hybrid. So we enforce something like ERM2, but with no target for a euro adoption. And we explain them this doesn't make very sense. It's the Danish model, and you lose that's the impossible trinity again. You use the possibility of the independent monetary policy.
Absolutely. Yeah.
So I think that one day the Czechs will enter the ERM2, and but that is not on the table yet. There are other issues. Of course, there is a very intensive debate among the supporters and those who are against the euro adoptions. And those supporters say, look at the Slovakia, they have a euro, they have low interest rates, and they have almost the same inflation like you, the same growth, the same pattern. So it's a very interesting issue for the debate, but currently it's not a no decision. And we also raised the question if in fact the measure for the currently approaching countries to ERM2, like Bulgaria, Croatia, and others, so first you have to you have to join the banking union and a resolution mechanism, and only then you are allowed to enter the ERM2. We say this is not completely, it has to be discretionary for those countries if they find it as a stabilizing factor. But it cannot be obligatory because it's in odds with the European law.
Absolutely.
And but the current consensus in the EU is in the Eurozone is it has to be obligatory for everyone. And this is something the government has to discuss with the counterparts in the Eurozone and the European Commission. So this is one of the issues, also technical, but this is exactly only for the debate among the experts, and a very small group of experts, but normal people don't take care about it. They see high inflation. They see the inflation in Germany is lower. They see in Germany they have lower interest rates now, and we have higher. So now it's the strengthening, I would say, support for the euro adoption.
Yeah, and that's very interesting. I just want to underscore a point I think Tina made, which I didn't really fully appreciate, but it was very. I think it's very important. Is that the Slovenia joining the euro in 2007, it joined under very different circumstances. The set of mechanism that you outline, right, just was not there. The banking union, supervisory mechanism, all of those things. It really was an experiment. It was a sort of first draft, right? So Boris, in some sense, Croatia is joining in a much more fully formed monetary union. Though, right, there are obviously some things that still remain, and so that brings me to the next question, which is, has to do with the loss of monetary sovereignty. I mean, you might have already de facto, now it's de jure, right? But at least you get to go to Frankfurt and participate in the debates, so that's good. You can influence. But it is, right, it is the case, and I think this was very, very, starkly exposed by the GFC and then the subsequent Eurozone crisis, the inability to respond to country-specific shocks. And just to sort of, just to have something to look at, so the audience in this, So just to give you a sense, this is just real GDP growth for the three countries that are here, and that shaded area in the middle, that's the global financial crisis, originated in the US at the end of 2007, right? Peaked with the collapse of Lehman in the September 2008, right? As you can see, it hit, in the United States, this materialized much quicker. It took some time for Eurozone to feel the cross-Atlantic shock, but when it did, it felt it very severely, right? And then you can see, the massive decline in real economic growth. I mean, these are stunning numbers, right? 10% real declines in GDP. I mean, US, which was the source of the shock, which were the brunt, right? We're talking year-over-year decline of 5%, was even revised less than that. So these are very, very strong numbers, and you can see a very anemic recovery, another dip at the end of the 2011 end, and a very, very, sluggish recovery, right? So this is precisely what sort of economists, more like me, like a research guys, right? This is like saying what is the problem with this picture? You lose monetary sovereignty, but you do not have common fiscal policy, right? You can't respond to these highly asymmetric shocks that materialize. So what are the sort of mechanisms that you can, I mean, this is still the present. The fiscal union is still perhaps, far, in the future. What are the mechanisms that you can do to try to deal with asymmetric shocks, given the fact that the monetary policy doesn't have, it's tailored to one-fits-all type of problem. What is the things, that you can think when you get this kind of asymmetric shock?
Well, okay, there's a problem with this picture, and there's something positive about this picture, if I look at it as an economist also. One is, as you said, I mean, you don't have in the monetary union the monetary policy to respond. But the other one is that, I mean, of course, we do it in a bit different, more precise way, but that shows you that there is a synchronicity of cycles.
Absolutely. Yeah.
And that common shocks, is asymmetric in the sense of how they hit the different economies. So the common monetary policy fits then all countries, and we should not complain too much about lack of the common monetary policy as long as the business cycles are synchronized and as long as shocks are symmetric in a sense that they explain the GDP dynamics in the same way in all the countries. And this is what we find out when we do the analysis of the synchron. This is this kind of it became like a catch-all meta property of the optimal currency union research that we do. It's a bit informal model, but kind of catches all into one when you show that there is a business cycle synchronicity and the symmetric shocks affect the economies in the same way. Okay, but having said that, if you do want to do something different than the others, for example, now you have a bit of a problem because recently you have a dispersion of the inflation rates. Mm-hmm. So that means that the symmetric shock is not affecting all countries in the same way, which is another, I would say, challenge now for the ECB monetary policy. Okay, what do you have to deal with that? And it's not monetary policy. There we go to what Alfred was talking about, fiscal space. If you do have a fiscal space, you can respond. If you have no fiscal space, you cannot respond. This is a kind of macroeconomic response. The other thing is what you said, and this is like structural policies, but that takes a long time. This is really not something that works through a cycle.
You don't address cyclical
this is something, but then again, having said that, what we also have to have in mind is that having the right structure, let's say, of labor and product markets allows the economy to adjust itself cyclically better than if it's not the case. So whenever you set that mechanism in motion, it works through the cycles, and it's good. So these are the things that we have. We also have a macro proof, which Tina mentioned. But the problem with the macro proof, however, is we started with the macro proof. We were in a way in Croatia pioneers of the macro proof before the GFC. In 2000s, we did lots of macro-pro. It was not called a macro-pro at that time. We didn't know we were doing macro-pro, but we were doing lots of it. What my take-up from that is, macro-pro works well when it moves in the same direction as a monetary policy. It works much worse when it goes opposite to the monetary policy. And this is something which I told my friends in the ECB over and over. Don't think that you can make up with the macro-pro monetary policy stance, that the monetary policy can go this way and the macro-pro can go that way, because monetary wins.
Absolutely.
Full stop. Monetary always wins. Okay. And you can actually introduce then problems into the economy that you don't want to have there with the macro-pro.
Absolutely.
Let me say one thing where people say macro-pro can do a lot is the housing market. Imagine you have a very loose monetary policy stance, as you have at the moment, still negative interest rates, inflation rate at 7.5%, and so you have a low mortgage rates, and you have a low deposit rate, so people take cash and put it into the housing market. You try to do something with the macro-pro, okay, it doesn't affect at all the market which is non-leveraged. Lower the interest rate, more non-leveraged market you have. Second, the part of the market that it does affect is typically market for first-time young home buyers, exactly those that you would not like to affect. So what the government then does is, because you introduce a distortion basically through the macro-pro, is that they start to subsidize young. As they subsidize, prices go up further. And you get into this vicious circle. Right. So yes, macro-pro is a very good tool. It serves us very well, but not this way.
That's a very good point, yeah. I think we have a few more minutes left. I would also like to invite the audience, if perhaps you have questions for our panels on recent developments. We have some microphones here. Please raise your hand. We'll be happy to take. I'm sure they will be happy to answer. Anyone?
Yeah, thank you very much. Stanislava Zadravec, Banking Association of Slovenia. If I may, a question looking a bit more forward, or a question for a country that doesn't have a euro introduced, and I would say country that is entering and country that is already in, where we have seen that the current external shocks, especially energy prices, are reflected in the domestic inflation in different levels, no? Different span of the effects. So I am aware that there may be limitations allowing you not to answer exactly straightforward, but nevertheless, what do you think, all of the three of you, in different monetary type of positions in terms of instruments available, what should be the best way forward, taking into account tiny specifics within the countries, but then also overall European landscape?
Okay, great, thank you. So maybe we'll start to the extent that you can answer that question. We'll start with you, Tina.
Okay, yeah. So I would say, first also, we are in the euro area, we have a common monetary policy with a clear mandate, and we have heard before that preserving monetary policy credibility is key. So I think it's also key to act in the manner to really preserve this credibility. This will help anchor inflation expectations, lessen the risk of this wage price spiral that we talked before. So we cannot influence, obviously, the energy prices. We do take them into account. We look into how they pass on through the economy. And what we have seen recently, that it's not really the energy prices only, but inflation has become broad-based. So we see it in the majority of the components. And so I think our focus, also the Madam President said, is really on normalization and preserving the credibility of our monetary policy.
Okay. Boris, you as entering the euro in this interesting times.
Yeah, I can add that when it comes to Croatia, we very much welcome the normalization, because if we enter, we'll see whether we enter, but if we enter on the 1st of January 2023 and ECB has not normalized, then our monetary policy stance will loosen, because our current interest rate is higher than the ECB. And this is not very suitable for us at the moment to loosen the monetary policy stance. So we are very much looking forward towards the announced normalization of the monetary policy of the ECB, because it also suits us. It
suits you in terms of the entry. Oh, interesting. Huh. Wojtek, you as a inflation targeter, your own currency.
So what would be the reaction to the current situation?
I mean, you've already started doing, right? I mean, you started moving aggressively, start middle of next year.
Actually, just the question of what would happen if we already were in the Eurozone. So now, with the current economic fundamentals we are observing for the 3-4 years, it will be probably much higher inflation than we have now.
Sure.
So in this case, the independent monetary policy is a sort of cushion against these shocks from the domestic economy and so on. And for us, of course, there's also the debate how temporary or how permanent those shocks are. And gradually, other central banks, in fact, are joining our camp. So even Fed was very same narrative as the ECB by saying this is just a temporary, this too shall pass, this is just the economy was, the global economy was hit by COVID, and we will have more containers soon, and disruptions in the supply and producer chains will disappear and dissipate and so on. It seems this is a more structural problem, and even the Fed started to very aggressively tighten the monetary policy. I am afraid that the problem with the energy prices is just on the top of this. And we cannot forget that if we see inflation, for long there were no inflation observed. And I remember before COVID there were so many seminars and conferences about too low for too long, and new normal in a low inflationary environment, secular stagnation and so on. But the inflation was always here, but it was like the Eagles when they reunited and made a concert, and they said we did never break up, we just took a 25-year vacation. And inflation took vacation, now it's here. And I think now it will be important to join cooperation of many responsible central banks to tackle with inflation and not neglect it. And of course, one of the biggest sources of inflation for us is imported inflation for the Eurozone, because Eurozone is our biggest partner. And not only energy prices, we see already other items. And this is not something that to advise to Eurozone, it's a different animal, and it's a different economy with a different structure and everything. But for us, if we see that the Eurozone is going to tighten, for us it means we will have to tighten more because the interest rate differential is important factor that curbs and prevents the currency from depreciation, and this is the filter for the import prices. So I think that globally we will see much more tightening of the central banks than we see now, and we will see higher interest rates for a longer period, because I think that the potential of the global economy has a very similar pattern like the Czech one. So it's lower than it used to be, and the benefits from the globalization are probably gone, and there will be deglobalization. There will be a lot of money have to be invested into the energy independence. When we are speaking about the fiscal stimulus in times of crisis like currently, what's better, to supply people and to compensate them for the increase of energy, or take the money and invest them into the greening and increase the independence in long term? So So yes, this is plenty of answers, but I think that many banks already follow the tightening path, and the other will join as well.
Yeah.
But,
yeah, no, I think these are, I would certainly agree that as the modal outcome, that we are now at a point where particularly a lot of EMEs have already started moving along this. Advanced economies are following. But I think that from a broader perspective is that central banking, there were lots of policy mistakes that were made in the 1970s and early 1980s, or late 60s and 1970s, sort of the last period where we had sort of high and sustained inflation. And I think the institutions, the central banking institutions, are far, far stronger. Their central banking independence has been enshrined. It is understood. It's also understood by politicians to a far more significant degree, and the central bankers know, okay, what they need to do. So I think they are, but nevertheless, navigating these treacherous and uncertain waters is going to be difficult. So this brings us to the end of the first round. I apologize for running for a few minutes over. Please, the audience, join me for warm thanks, applause for this stimulating discussion. Thank you very much.
Well, good afternoon and welcome to the second part of today's conference. I'm honored to lead you through the second session. Like in the first part, we will start with 2 keynote speeches, followed by a roundtable discussion. Let's say that the first part of today's conference acted as a rearview mirror in terms of decisions and events, especially for the transition economies. Well, this part of the conference will try to identify the key challenges that central banks will likely to face in the near future. As an introduction to the second part of the conference, Mr. Claudio Borio, Head of Monetary and Economic Department at the Bank of International Settlements, and Mr. Janez Potočnik, co-chair of the United Nations International Resource Panel, will deliver their keynote speeches. First, we will hear from Mr. Borio, who is an author of numerous publications in the fields of monetary economics, banking, finance, and issues related to financial stability, and has extensive policy experience in these fields. Later, Mr. Potočnik will deliver his keynote address. Through his career, he has focused on environmental issues and consequences of economic policy making, and also held the position of the European Commissioner for the Environment. His address will focus on the issues related to climate change and how policymakers approach them. Unfortunately, due to scheduling issues, Mr. Borio was unable to attend today's conference, but instead agreed to send us a pre-recorded video. So now I would kindly ask the technicians to play the video, and afterwards I would kindly ask Mr. Potočnik to address. Thank you.
I would very much like to thank the organizers for their kind invitation. I'm delighted to be here for the 30th anniversary of the Central Bank of Slovenia. And of course, I'm very, very sorry for having to do this from here, to pre-record these remarks as a result of a commitment clash. I have been asked to talk about central bank challenges, and I would like to focus only on one. That is, how best to reconcile price stability with financial and hence macroeconomic stability. I think this challenge has been highlighted by the momentous changes that we have seen in the global economy over the past 50 years or so, and more recently by the COVID crisis, and of course by the tragic war in Ukraine. In doing this, I will raise some questions about the analytical lens which is used in order to tackle those challenges. And I will have to be necessarily succinct, but I'll be drawing on work carried out over the years with colleagues, research in the various aspects that I will be describing, and draw on a thematic chapter on inflation that will be appearing in the forthcoming annual economic report, which will come out in June, and I will very much encourage you to have a look at it. Now, despite all this, the usual disclaimer applies. The views that I'll be expressing are my own and not necessarily those of the BIS. So let me start with the major changes, shifts in the economic environment that we have seen since the 50 years ago, roughly. One underappreciated one has been the change in the nature of the business cycle from what I would call inflation-induced to financial cycle-induced or simply financial recessions. And of course, I'm leaving aside the COVID-19 recession because, as we know, it's sui generis and it was triggered by an exogenous health shock. So until the mid-1980s, recessions were triggered by an increase in inflation, which required a monetary policy tightening with rather little happening to indicators of financial expansions and contractions, such as credit, asset prices, risk-taking. Since then, however, we know that inflation has been stable, so there has been little need for a tightening of monetary policy. But what we have seen are big financial expansions that have turned into contractions, financial booms turning into financial busts. And of course, the great financial crisis is the most obvious example of this phenomenon. Now, I think that this shift in the nature of the business cycle has been supported by two tectonic structural forces. First of all, financial liberalization, which has provided more room, ampler room for these financial expansions and contractions to take place. And secondly, globalization, in particular the globalization of the real economy, which has exerted major disinflationary pressures on the global economy, helping central banks to keep inflation in check. Now we're facing a unique configuration in the post-war era since the Second World War, and that is an increase in inflation which has coincided with financial vulnerabilities. Financial vulnerabilities in flow terms, think for example of the aggressive risk-taking that we have seen, particularly in the non-bank financial sector, and soaring house prices around the world, but probably, and even more importantly, financial vulnerabilities in stock terms. That is the fact that debt levels, private but also public debt levels, are the highest in history. Now, the intellectual paradigms prevailing during this historical phase, and this is my key thesis, I think made it hard to understand what was happening and to anticipate what might happen. And I think these paradigms encourage two basic inferences. First, that price stability was sufficient for financial and hence for macroeconomic stability, and that the inflation scourge had been eradicated once and for all. Now, I would summarize these intellectual paradigms in two beliefs, and let me stress, I'm going to be intentionally stylized here. Now, the first belief is that the economy is self-stabilizing. And that's reflected in the way that economists think about the business cycle. That is, exogenous shocks that propagate across the economy, but then usher in a slow, gradual, but orderly, in particular, return to steady state, so that there are no expansions that generate subsequent contractions. There is no endogenous cycle, if you like. And alongside this, a secondary role for financial factors, so that inflation is the only signal that the economy is proceeding along an unsustainable path. The second belief is that the Phillips curve is broadly, and let me stress, broadly adequate as a description of the inflation process. A Phillips curve in which there is really no role for structural forces. We only have a role for economic lag, for a direct role for inflation expectations, and then some transitory shocks, for example, big increases in the price of oil. And also no role for sector-specific factors. We have quite naturally a single aggregate measure of economic slack, and therefore there is little attention to the disaggregated price dynamics that take place below the surface of aggregate inflation. Now, taken together, these two beliefs tended to encourage a certain underestimation of the buildup of financial vulnerabilities and of their consequences, a certain underestimation of the self-correcting properties of inflation when it settles at a low level, because at that level, inflation tends to reflect largely changes in idiosyncratic prices, idiosyncratic changes in prices, a certain underestimation of how hard it would be for monetary policy to raise inflation back towards target, because monetary policy had to tackle powerful secular disinflationary forces, benign disinflationary forces, and because the idiosyncratic component of inflation is very unresponsive to monetary policy. And finally, an underestimation of inflationary pressures in the unique post-COVID landscape, not least and not only because sectoral factors have played such an important role. And let me stress that here we at the BIS simply didn't see it coming either. Why do I say that the two beliefs helped explain where we are now? Well, because they reinforce the downward drift in interest rates, nominal and real interest rates, to the lowest levels in history, because monetary policy was not sufficiently counter-cyclical during expansions, although of course it was quite counter-cyclical during contractions. And by the same token, this encouraged the gradual build-up in debt. Now, as I said before, we're facing rather unique and very testing economic circumstances because we have the conjunction of inflation with financial vulnerabilities. Now, the concern is that this increase in inflation may continue to prove persistently surprising. That is, in particular, following the major shock generated by the war in Ukraine. And that, as a result, we could transition from a low inflation to a high inflation regime. Why? Well, in the short term, I think we should not underestimate the possibility of wage price spirals, because we don't really need an increase in inflation expectations. The only thing we need are successful attempts to recoup losses in purchasing power and to compensate for squeezes in profit margins that have already occurred. Now, this could happen at any degree of slack, and it's more likely to happen in those countries that are experiencing terms of trade losses, because, of course, if the pie gets smaller, the fight over it gets bigger. Now, remember the experience of the 1970s. And in the long term, signs of a retreat from globalization are quite worrying, because they could give back to labor and firms part of the pricing power that they had taken away before the current phase. Now, if the transition to a high inflation regime does take place, its self-reinforcing tendencies will make it harder and more costly to return to a low inflation regime, the inflation regime that we have enjoyed for so many years now. And this is the reason why Agustin Carstens, in a recent speech in Geneva, raised the possibility or the risk of that happening. Where do we go from here? Well, the two paradigms have come under close scrutiny in the light of the great financial crisis and the post-COVID experience, and now the war in the Ukraine. But I would say that the progress made is not quite there yet. I think that there is still more to go. Now let me take the two paradigms in turn. First of all, the paradigm that price stability is sufficient for financial and hence also macroeconomic stability. Well, clearly in those terms, the paradigm has been abandoned. Yet there are still some lingering doubts concerning both analysis and policy. Concerning the analysis, in sharp contrast to frameworks for financial stability advice, there has been little change in the workhorse models, macroeconomic models, that support monetary policy advice. And I think there is still surprisingly little understanding between these two wings of economists operating within central banks. And concerning policy, there is still a certain underappreciation of how hard it is for prudential authorities to do their job when interest rates are low for long, and a certain overestimation of what macroprudential policy can do on its own. For example, even where it has been used very aggressively, particularly in emerging market economies, it has not prevented the buildup of financial imbalances, costly financial imbalances, or at least the buildup of the signs of those imbalances. Second paradigm, the idea that the inflation scourge had been eradicated once and for all. Again, in those terms, obviously the paradigm has been abandoned as a result of the latest developments. Yet here too, there are some lingering doubts concerning both analysis and policy. Concerning analysis, I think that the Phillips curve has still a rather powerful and pervasive influence, which often goes unrecognized in the dominant role of economic slack, in the little role for structural forces, in the little role for sectoral forces. If you like, it has become part of our intellectual furniture. And concerning policy, I think there is the need to be alert to the risk of underestimating how shocks can trigger wage price spirals, the kinds of price shocks that we have seen recently in the major increases in commodity prices, and how structural forces, and here I mean in particular deglobalization, could entrench a high inflation regime. Now, if this analysis is broadly correct, what are the implications for policy? Particularly for, if you like, the broad direction of travel for policy. Well, as we have argued at the BIS, what we would like to see is a path towards a more holistic macrofinancial stability framework, in which monetary policy, prudential policy, both micro and macro, but also fiscal policy, all have a role to play, a consistent role to play. And this is still very much a work in progress. Thank you.
Najprej dober dan in hvala lepa za povabilo. Ladies and gentlemen, dear friends, thank you for the invitation. First, COVID-19 and now war in Ukraine have shaken the world's commodity chains. Shortages and fears of shortages are stretching European economies. Such system shocks echoes deeply. It is not just shipments of food and fuel, but the fertilizers and feeds at the right time in the farming cycle, and the rare metals on which the transformation of energy sector relies. In the European Union, leaders are addressing the crisis with measures to improve Europe's strategic autonomy. In your competence area, most developed economies and also the euro area have been experiencing inflation at historical levels. As a result of a strong response of fiscal and monetary policy, the euro area economy has recovered strongly from the pandemic shock. In contrast to the response during the euro area sovereign debt crisis, governments have provided coordinated and unprecedented support for economy. However, this has led debt levels to increase further, and the Governing Council of the ECB have already been reviewing its monetary policy strategy. While it is paramount that we address the serious knock-on effects of the crisis, we cannot afford to discontinue our sustainability efforts. We can no longer ignore how fragile our economies and societies are, and how important it is to increase their resilience. Prescribing painkillers and trying to remove merely the short-term pain will not heal the disease. And the next crisis will find us soon again and still searching in panic for ad hoc solutions. When everything seems to be running well, food and energy security or monetary stability are taken for granted. But food security is not a stockpiling mentality or an intensification only of input and production. It is about changing how much we produce for direct human consumption rather than animal feed. It is about upscaling systems like agroforestry, which simultaneously provide food and beneficial ecosystem services. It is about technologies, precision agriculture, vertical farming, and meat alternatives. It is about food waste and the equally unethical waste of land, energy, and pesticides on uneaten food. It is about health of our pollinators, health of our soil. Food security is also about broader policies. The proportion of food crops and soil used to produce biofuels, the extent of fertile land being swallowed by expanding cities or resource-consuming inefficient transport systems. Likewise, energy security does not mean replacing one source of fossil fuel with another or from another region. It is not even primarily about providing abundant and affordable renewable energy. Beyond producing cleaner, low-energy steel, we need to look at how much steel we use in our terribly underutilized cars. It is about shared mobility alternatives to cars and better designated cities. It is about how efficient our homes are built and the amount of space we use for our living needs. It is about our behavioral choices, such as working from home, and when we are there, how well the products we consume, their lifetime, their upgradability, repairability, recyclability, supports us in those choices. It is about energy used to produce the clothing we are wearing, or even worse, not wearing. And as you know better than me, monetary stability is not only about immediate needs to supervise and control the inflation pressures, but it's also about all the challenges you face due to the financial sector aspiration for higher profits, and in a role you must play to help the needed transformation of our real economy. This multiple approach may seem a long way from the economic counter-offensive, the single swift response that political and media logic demands. But it is less strange to those working to hold back the underlying planetary crisis. Here, the cumulative effect of many positive system-changing decisions is almost the only way. Think keeping a stable and safe world within our reach. While dealing with acute challenges, we are also facing an emerging chronic and systemic environmental and social crisis due to the overuse of natural resources and uneven and unfair distribution of their benefits. The triple planetary crisis, climate, biodiversity, and pollution, is making instability the norm. Natural resources are the heart of our environmental and human health challenges. The use of materials, fossil fuels, metals, minerals, biomass, that is everything we extract from the earth, has tripled since 1970 and accounts for a huge share of greenhouse gas emissions. In overusing earth resources and by distributing the benefits unfairly, our economic model is taking far more than the planet can sustainably give. In recent decades, resource use has significantly improved living standards and well-being in many parts of the world. But it is now coming at an unprecedented cost to climate, environment, and health. The problem is that humankind has never separated out economic growth from ever-rising demand for resources. As a result, we are now overstepping planetary boundaries and locking ourselves out of the safe operating space in which human societies evolved. We must instead link resource use to fundamental human needs and optimize the systems that deliver them. We do not need car, we need mobility. We do not need chair, we need to sit comfortably. We do not need a fridge, we need fresh, healthy food. So much extracted materials goes into underutilized cars, inefficient built cities, and poorly maintained machinery. If we look at our production and consumption through the lens of natural resource use, we can start to look at the transformation of the whole system, not just of a specific sector. We need to reject the assumption that these systems need to be resource intensive. As a university student, I was taught that economic theory is based on the rational behavior of consumers and producers. The more we produce at the lowest possible price, the higher the capital returns and GDP growth. But what if the whole economic system was at fault? Undervalued human capital and in many cases not valued natural capital by our markets are leading to systemic social and environmental imbalances. Imagine that, for example, a customer, let's say of Mercator, would enter the food shopping center and not pay, or at least not pay the full price for the things taken home. Mercator would soon get bankrupt. The same is happening to nature. Nature is a large ecosystem getting bankrupt due to our behavior. Our short-term rational behavior is leading to long-term irrational, charming mass suicide, as Arto Pasilina titled one of his excellent novels. Our international efforts to fight the climate crisis remain focused and are driven by the supply side. This, the recent IPCC report warns, will fail to limit warming to 1.5 degrees Celsius. But authors add that demand-side mitigation could reduce global GHG in some sectors by up to 70% by 2050. More fundamentally, demand-side measures get us closer to the human questions and responsibility of equity. High-income regions, including Europe, must take the lead. Resource efficiency should thus be complemented also with sufficiency-based policies. Until then, ambitious policies such as European Union's Green Deal and UNFCCC targets face an uphill battle to implement incentives and regulations to change our production and consumption patterns. Sending policy signals one way and market signals the other, it's just creating confusion, not to mention intense lobbying of companies that fear the loss of profitable markets. It's time to stop signaling to producers that destroying natural capital is free of charge. It's time to stop with contradictory messages to consumers who still routinely pay more for food with a low environmental impact instead of the reverse. Dear friends, we are in an unprecedented time on many levels. While challenging, this is also a great opportunity to create positive lock-ins for more resilient, fairer, healthier economic models for both, for people and for the planet. The European Green Deal is clear in its vision and ambition, aiming not only to reach net zero emissions, but also to decouple economic growth and human well-being from emissions and resource use. While decreasing inequality, it aims leaving no one behind. This is European Union's new growth strategy rather than the new environmental and climate package, mainstreaming sustainability across all policy areas. This gives a clear message also to private banks and to European public institutions, financial institutions, encouraging them to redefine priorities and offering stability to sustainable investors. Economic activity depends on investment. Therefore, investors have enormous power to determine the type of economic activity taking place. Currently, financial flows towards natural assets and sustainable economic activities are still dwarfed by financial flows which harm nature and contribute to climate change. Clearly, this balance needs to shift, and the direction is clear as pointed also by Larry Fink, Chairman and CEO of BlackRock in January this year. I'm quoting, "The next 1,000 unicorns won't be search engines or social media companies. They will be sustainable, scalable innovators. Startups that help the world to decarbonize and make the energy transition affordable for all consumers." End of quote. Private investors often avoid greening portfolios, investing in opportunities like those highlighted above, stating that they have a duty to maximize short-term return for their shareholders rather than to contribute to societal goals more broadly. It is not yet widely recognized that financial activity which serves the well-being of people, including the well-being of our planet, is what will ultimately derive sustainable returns for shareholders through providing long-term consistency and stability. What is needed? It's a better alignment of short-term optimization with longer-term needs. It is not only the fiduciary duty of investors to act now to protect client assets, but there is also a ripe opportunity for the finance sector to champion sustainability leadership and shift the entire economy in safer direction, which will best protect clients and reap opportunity. Private investors have a crucial role in greening their portfolio through supporting innovative opportunities, but they are acting within a regulatory framework, which incentivizes concentrated profit maximization and does not always recognize environmental risk. Which leads me to the role of regulators and of the whole financial system, to the central banks. Thanks to your key roles in maintaining price stability and consumer confidence and setting direction for private finance, central banks are privileged and uniquely positioned to facilitate this transition. Central banks are publicly owned institutions whose mandates are set by their governments, so you should reflect the long-term interests of the societies you serve. Central banks influence the economy in two major ways: monetary policy and financial regulation. Monetary policy aims to control price stability, preventing massive inflation or deflation. This involves adjusting interest rates and buying and selling financial assets like government bonds. And all that have a huge direct impact also on the consumption, and ultimately it is linked to increased natural resource use. Financial regulation is another central bank's major responsibility. Microprudential, regulating individual financial institutions, and macroprudential, regulating the financial system. Macroprudential policy empowers central banks to maintain stability, preventing bubbles and economic shocks. You have a crucial role in setting the direction for private finance, determining how markets act, forcing markets to recognize and respond to real crises. The topic of natural resource management, however, it's one that is not widely understood, and thus a key next step is understanding nature-related physical transition and liability risks. Given the stability focus being central banks' main aim, financing sustainable natural resource use should be a primary objective. You have the capacity to change your mandates to cope with the most pressing challenges of the day. Some are already updating mandates to reflect central banks' role in combating climate change and nature destruction. ECB has, for example, drawn up an ambitious climate action plan. Though it is an extremely encouraging signal, the ECB's climate action plan has received also criticism for being too vague to effectively prevent financial flows to big fossil fuel users. Central banks have been also conducting research and analysis to better understand the climate risk commercial banks face. For instance, more than 50 central banks have banded together to form the Network for Greening the Financial System, which recently published climate scenarios to stress test the system. Building on this, the ECB and French Central Bank jointly conducted another economy-wide stress test and concluded that, I'm quoting, "There are clear benefits in acting early. The short-term costs of the transition pale in comparison to the costs of unfettered climate change in the medium to long term." The recent IPCC report is also clear. Containing warming to 2 degrees Celsius would require actions that limit global economic growth by 1.3 to 2.7 by 2050. However, that loss would likely be outweighed by the overall economic benefit of limiting warming itself. Question more and more resonating about many is how much growth maximization measured in GDP is really still correlated with increasing well-being. In particular, in high and upper middle income countries, the very countries who consume the most of resources per person. We need to rethink the North Star leading our behavior and our policies. What would need to be the next steps linked to financial sector? To encourage central banks and the governments who determine their mandates to fundamentally embed action on sustainable natural resource use, we need to ask the right questions for the next steps. Their overall objective is economic and social stability. Given the triple planetary crisis, this must mean responding to climate change and nature destruction. For monetary policy, can central banks go beyond their current commitments to prioritize investment which stimulates sustainable resource use? On the financial regulation side, can central banks make it a mandatory requirement for all financial institutions to publish credible transition plans aligned with Paris and Glasgow goals and planetary boundaries? Can emission-heavy investments be defined as too risky to be viable? As mentioned, the financial system and the real economy are deeply connected and depend on one another. It is in the financial system's interest to operate in a manner which supports and protects our planet while contributing to societal goals, ultimately supporting societal well-being and stability, which means ending support to unsustainable natural resource use. Real system change will require a broader conception of what value is. Mark Carney, ex-governor of Bank of England, discusses this in his 2021 book titled Values. He argues that market values and an over-reliance on market forces by governments and regulators have led to a society that is unable to express what is important to it. He suggests 7 key values: solidarity, fairness, responsibility, reliance, sustainability, dynamism, and humility, which led to 3 elements of good society: fairness between generations, income distributions, and life chances. He argues that governments who most overlook these values were the least prepared for COVID-19 and that they are making the same mistake with the climate change. As you know, Mark Carney also unveiled the Glasgow Financial Alliance for Net Zero last April during the Climate Convention. In commenting developments since COP26, he argues that Russia's invasion has hampered the pace of decarbonization because it will use up more of the carbon budget. But in the longer term, he insists, the war is convincing governments of the need to create energy security with domestic and renewable resources. He listed also very concrete recommendations that will emerge from the alliance in June, around 5 pillars. How companies can create practical climate transition plans. How the financial sector can support a managed phase-out of high-emitting assets. How finance can find effective pathways for sectors such as steel, transport, and agriculture and measure progress there. How to tackle problems with the quality and availability of data. And finally, how financial groups can align their portfolios with net zero. There is already a high level of agreement that the transition to a more sustainable society and economy has no reasonable alternative. But ultimately, it will be about the speed and scale of transition. It will be about addressing key drivers and pressures that cause the challenges we are facing, about providing systemic perspective to guide decision-making, and about channeling sufficient investments aligned with recovery needs to support the transition. Financial sector, central banks in particular, are playing and will play a central role also in the future. What is needed now from central bank strategies is greater precision on how their action on the planetary crisis and its drivers can have maximum impact. To conclude, making our fragile economies and societies more sustainable and resilient, it's our best defense against any future crisis. In the longer term, food and energy security or monetary stability are not about opening a new economic front. They are, first of all, about reassessing our values, rethinking our economies, and reducing overconsumption. Standards and behavior patterns linked to the current economic model were set by high-income countries. We are ethically bound to show the world that we are willing and able to change the reality we created and to lead the essential transition at home and globally. The map of resource use still shows the shadows of imperialist world, where wealthy nations pursue their ambitions at the expense of others. A more stable and sustainably prosperous future will mean shifting to an era of responsible resource use where benefits are more fairly shared, mitigating resource fragility and strengthening our preparedness and resilience. The more we avoid these strategic, sometimes difficult decisions, the more likely is that we will get them soon back on our tables. For the future we want, we need a system-based approach, minimizing trade-offs and future lock-ins, maximizing co-benefits and synergies among all our efforts. Focusing only on cleaning the current production system will unfortunately not be enough. We must enter the untapped territories of the needed deep system transformation. If we want to avoid extinction of elephants in nature, we need to extinct elephants in our rooms. According to the Dasgupta review, our unsustainable engagement with nature can be traced to institutional failure and to the failure of contemporary economics to acknowledge that we humans are embedded with nature and not external to it. So for the beginning, it would be really good to agree that we humans are part of nature and start behaving accordingly. And this should be acknowledged not only by all the governments, but also by the financial system and by central banks. Limiting attention of central banks to rather narrow monetary-related questions would be just a sign that you underestimate the importance of your role and also underestimate your responsibility in addressing the challenges we collectively face as a globalized economy and interdependent society. My sincere congratulations to the Bank of Slovenia for 30th anniversary. Good luck with your demanding tasks, and thank you for your attention.
First, let me thank to both presenters, Mr. Potočnik and Mr. Borio, for their interesting and thought-provoking speech. Well, in the morning, we have heard how in the past 30 years, policymakers, especially central bankers, have seen tackle several crises and stumble upon severe challenges. Now, we have seen introduction of new currencies, the establishment and subsequent enlargement of the monetary union, global financial, sovereign debt, and finally, the pandemic crisis. I believe it's right to say that also in the light of the tragic events unfolding not far from here, it's very likely that also the road ahead will not be smooth. So in the short run, one of the important issues we will have to tackle, and it was mentioned already many times today, is the normalization of the monetary policy. Policymakers will need to strike, as was mentioned also by Borio, a delicate balance between addressing the actually high inflation and making sure that tighter monetary policy does not produce undesirable fragmentations in financial markets or endangers financial stability or reduces the economic potential. At the same time, current events must not take our attention from the structural changes that will importantly shape our future, like the green transition, digitalization, and demographic change. And we will try to address all this issue in the coming session. So now I would kindly invite all the distinguished panelists to come to the podium. So first Mário Centeno, the Governor of Bank de Portugal. Madis Müller, Governor of Eesti Bank. Welcome. Boštjan Vasle, Governor of Banka Slovenije, and Claudia Buch, Vice President of the Deutsche Bank. Welcome. So, welcome here. Maybe to kick off the discussion, let us first turn on arguably probably currently the most pressing issue that was also mentioned very often today, and this is inflation. So most developed economies, and also the euro area is no exception, have recently been experiencing inflation at historically high levels. So many are arguing that actually the current spell of inflation is a consequence of uneven recovery of supply and demand, following a negative COVID-related shock to both. And in addition, we were also hit by Russia's aggression against Ukraine. So Governor Vasle, what is, in your opinion, a root cause of current inflation? To what extent should we learn from the pandemic and post-pandemic period and in our reactions both in terms of the scale and timing?
Thank you very much, Ariana, for this question, which really is a central one today for general public as well for the policymaker. Now, regarding inflation, just to start with a short look at the time scale, we all remember that at the beginning of last year, we still had quite an opposite situation. Inflation was low, even too low for our standards, and then it slowly started to increase. And by the second half of the year, we were witnessing relatively high levels of inflation. Now, moving towards this year, inflation accelerated further and is now standing not just in relatively, but really at the high levels. Now, the roots of inflation, or the main contributors of inflation, has also changed during this period, whereas in 2021 we were still seeing inflation as induced by some one-off factors, some then described as a temporary influences. Now the situation is different. And yes, I can agree with you that at the start of the process of slowly increasing inflation, there were reasons mostly related to the pandemic crisis, namely the slow vanishing of COVID infections caused a rebound of energy prices, which were main contributor to inflation. It's also caused increased demand, which again contributed to higher prices, especially given the fact that recovery was uneven and we were been faced with a serious supply shock, supply side shocks, all the disruptions with value chains and so on. But at the beginning of this year, we realized that this one-off factors started to move forward to other prices, and now we are faced with a situation where there are basically many different groups of goods and services which are growing at more than 2%. That's one thing. We are also faced with additional pipeline pressures. We know that there are some input prices which are growing very fast, and there is a high probability that they will be translated or passed through to other prices. So this is one factor. Then the second thing which is behind inflation are changed expectations. During the past months, we saw a significant change in our expectations. I mean, the expectations of the citizens, of expectations of professional forecasters, also expectations of firms, and that are all factors which are influencing inflation. And now I very much agree with what was presented by the BIS, that we are in a different regime of inflation at the moment as compared to what we saw last year. So the roots are much more, the causes are much more deeply rooted, and that's the situation at the moment.
Thank you. So decisive policy support was crucial in supporting incomes and demand during the crisis and the recovery stage. Now, as a result of this strong response of fiscal and monetary policy, the euro area economy has recovered strongly from the pandemic shock. Now, in contrast to the response during the euro area sovereign debt crisis. And the reason is that the governments have provided coordinated and actually huge support for the economy. However, this has led debt levels to increase further and renewed calls for reforming the design of fiscal rules in euro area. So Governor Centeno, having contributed to both monetary and fiscal policy decisions in the capacity of the Minister of Finance, the President of Eurogroup, and now as the Governor of Bank of Portugal, how do you see the role of fiscal policy going forward? To what extent could elevated public debt present an obstacle to the normalization of the monetary policy?
Thank you. Thank you for the question. Thank you for the invitation. Congratulations to Banka Slovenije for the 30th anniversary. Well, after such an impressive speech by Yanis, I think we all need to be very humble here, not to say something that can be understood as an unavoidable truth, because we are really in very challenging times. The coordination of policies, especially in Europe, is, as you said, very much very close to my heart, both as a policy practitioner, but also as an economist, because I think really we need to take all dimensions of policy together when we take decisions. The truth is that we were quite successful in 2020 to respond to an unprecedented, unique crisis that obliged us to switch off our economic system, or at least big parts of our economic system, to rush with monetary and fiscal support, and the recovery was indeed very, very fast. I think it was faster than we initially expected. And with such a fast recovery, some events occurred that were not really anticipated. Claudio touched upon some of these events, and those, right now we can make a more clear interpretation of these events, which imply two very basic things seen as of today. On the one hand, supply bottlenecks, because it was much easier to switch off the system than to then take it back on a orderly way, because of the billions of connections that such an interlinked system implies, and we now face still a little bit, or substantial part of this, but also because the recovery was quite biased in terms of demand. It was based on a big shift of demand towards some goods, mainly durable goods, away of services. Well, we all expected through 2021 that these two difficulties could fade away as demand become more balanced, and as the economies recover with the reduction of these supply bottlenecks. And suddenly a new shock arrived. whereas the role of fiscal policy in COVID was very clear, today it is also much more challenging. So also in terms of the coordination of monetary and fiscal policies, it was much easier in 2020 than it is today, because we need to find a way to communicate together. And this is probably one of the most difficult issues in terms of coordination of policies, because the role of monetary policy is very clear, although narrow. I understand your concern. But the scope for fiscal policy today is a little bit more ambiguous. And I say that because of the following. Whereas COVID was always interpreted, and I think rightly so, as a temporary impact in our economies, the challenges we face today are much more structural in nature. And to put forward solutions to structural problems, which are not new, we were already preparing for that. The program of the 2019 European Commission was already based on this dimension of climate change. We today feel the need to accelerate a lot this transition for all the good reasons that we just heard before, and for those that we already knew. So today, this energy shock that is being reflected in prices, Governor Vasle explained it very well. In statistical terms, we call this a positive duration dependence. The longer the shock, the more likely it is to spread, to contagious all other items in our consumption basket, and so in our inflation indicators. And this makes not conflicting, but a much more difficult task for monetary and fiscal policy to play together, because they should not, in my opinion, eliminate the signals that prices give to economic agents to direct their decisions. But we are facing with very high inflation, and we need to move. So my answer, to finalize my answer, I will say that this coordination is as important today as it was in 2020, but we need to work very, very well how we communicate that to our citizens, because contrary to what happened in 2020, now I find some conflicting interests in the table. Thank you.
Okay, so maintaining our focus on the topic of monetary policy normalization, I would like to broaden the scope of issues related to normalization. The Governing Council of the ECB has devoted a substantial amount of time and effort to review its monetary policy strategy. It was reviewed last year in December. And much focus was allotted to updating our strategy to an environment of narrow policy space. However, in the recent months, we are witnessing the events beyond the control of the central banks, and they can induce additional uncertainty and complicate the process of withdrawing policy accommodation. So, Governor Müller, you have been among the more vocal supporters of monetary policy normalization in the light of mounting inflation pressures. So, was the question of exit strategies from non-standard monetary policy measures, in your opinion, neglected within the strategy review? Or in terms of normalizing monetary policy, where do you see the appropriate balance between addressing the rising inflation and mounting financial risks along the normalization path? And what are the key issues we should be worried about in the process of the monetary policy normalization?
Well, Ariana, there were really many questions, but before I start answering, yes, let me really thank you and the organizers of the conference of inviting me. It's really a pleasure be here. I hope to, perhaps I'm able to take some of the nice weather back home to Estonia, where we haven't seen enough sun this year. But so thank you, Boštjan, and congratulations on your anniversary. Now coming to the first the strategy review and then the monetary policy normalization and what we should do. Maybe a few words on the strategy review first, because this is where we, among other things, also, for example, discussed what could the European Central Bank and the central banks in Europe more generally do when it comes to climate policies, and how that within our mandate is possible, and how we can contribute to the efforts of our governments, who of course are the primary drivers when it comes to environmental policy. So there are steps we are taken in that direction. It was interesting that still a year ago, or it was even a bit less than a year ago, when we finalized the strategy review, the situation really was remarkably different. So the background of the discussions was that for years we had the problem of too low inflation. So a lot of the analysis focused also the reasons behind that, the structural shifts that we have seen in the economy. But we also emphasized the need, for example, to be symmetric in our policy responses, meaning that as we now have even more clearly defined the 2% inflation target, then it is important that the central bank reacts similarly forcefully both to deviations upside and below to the 2% goal. Given the situation where we were in when the strategy review was undergoing, perhaps there was more focus indeed on how it is possible to manage the situation and handle monetary policy when the inflation is too low. But if you ask whether we disregarded the questions around exiting from the non-standard policy that we have now had with the negative rates and asset purchases for several years, then I would say the answer is still no. So clearly there was an understanding that we need to normalize the policy at some point. It's just that this point has arrived much sooner than any of us imagined a year ago. And in terms of specific wording of the decision or in the strategy, there was also what we call the forward guidance, indicating that what are the specific criteria for starting an increase in interest rates, which basically refers to the inflation being close to 2% in the foreseeable future, which I think pretty much now we have met, and also starting with the normalization of the policy, which already has indeed taken place to some extent. This will certainly continue, and I think we're not too far from ending asset purchases and also starting an increase in the interest rates. Now, you also asked about risks. Of course, there are risks involved in normalizing the policy. Certainly, we should also realize that there are and were risks involved with having a very low interest rates and very accommodative monetary policy for a long time, and that relates to asset prices and real estate markets, possible bubbles in the lending market, and so on. But of course, we need to be careful as we go about normalizing the policy. I think it needs to be gradual, as it has been also described by President Lagarde earlier this morning. So this is the road we have ahead of us. We need to manage the risk, but we also have to normalize the policy, indeed, given the current outlook for inflation.
Thank you. Now I would like to zoom in an issue which has, according to the ECB's outreach during the strategy review, been singled out as among the most important of the general public, so the real estate market. Real estate prices have risen sharply in the euro area, also in Slovenia in recent years, contributing to a decline in the affordability of housing and an accumulation of housing debt. So analysis indicates signs of an overvaluation of house prices in euro area, which together with higher indebtedness, which talked about before, could represent a vulnerability for the euro area financial system in the future, especially if significant price correction happens. So, Vice President Vuich, based on your academic work and extensive policy experience at the crossroads of monetary and macroprudential policy, how do you see the role of monetary policy and the ECB in relation to these developments, and what will rising interest rates imply for the stability of the financial system, and how and to what degree should monetary policy respond to house price and asset price developments? Thank you.
Thank you. Thank you also for this rich set of questions, but I'm afraid I also have to thank you first of all and say congratulations to the 30 years. I'm really happy to be back here in Slovenia because we have a very nice working relationship with the Slovenian Central Bank. We have organized many joint conferences, actually under the other Boštjan Vasle, many years ago, and so it would be nice if this could be a start after the pandemic to revive that relationship and to intensify that. So let me say that up front. Yeah, so I mean, you mentioned an issue, house prices and the role of monetary policy. That's actually very intensively discussed in Germany, and the Bundesbank is part of that discussion because we have a financial stability mandate actually coming also to the discussion what can and should central banks do. The Bundesbank financial stability mandate is actually joined also with politicians and with a supervisor. So in our case, supervision is not inside the central bank, and we have a committee, financial stability committee, that organizes and discusses this work, and the Bundesbank contributes to these discussions and analytically first and foremost. So we are not the macroprudential authority when it comes to that institutional aspect. But to your question, so to what extent are prices for real estate driven by monetary policy? I must say that I can't exactly disentangle what's the contribution of monetary policy and in general of low interest rates, because we've had a low interest rate environment for a long time, and it's of course not only monetary policy that's responsible for that. But clearly we've seen in Germany, we've seen a doubling of prices for real estate, and that's clearly driven by the low interest rate. So there's a lot of search for yield, and investors are looking for investment opportunities. But we've also had for a very long time prior to the pandemic, of course it was interrupted by the pandemic, we had very stable income growth, economic growth, so that contributed to low unemployment, rising income. So all these things, of course, contributed to the increase in prices. It's hard to say to what extent are houses overvalued. Is real estate overvalued in Germany? Our economists do what they can with their models, and they come up with estimates of about 15 to 35. Now, more recently, also saying about maybe 40% of the increase in house prices may not be justified by fundamentals, but it's a wide range of estimates. Now, what we then say in the public policy discussions about this, of course, many people say, well, this is all because of monetary policy and do something about it, but we'll come to that in a second. We say that when it comes to financial stability, we don't just look at the prices, but we look at whether this is driven by credit growth. And here we must say that credit growth has been very dynamic, also lending to households about 7%. That's the recent number, and that's above the historic average. So we're watching this very carefully. So we are so far not really seeing a deterioration of lending standards, but we're watching this very carefully. And actually the BaFin, so the supervisory authority, has taken measures in January to increase the countercyclical capital buffer to 75 basis points. I must say that is, again, this is often portrayed as being addressing risks to financial stability, but we are also concerned about, in general, that markets, investors might underestimate the risks that lie ahead of us, and we've heard many of those risks, so I don't have to add to that list. But clearly, I mean, if you just focus on the macroeconomic conditions, clearly what lies ahead of us is very uncertain. I personally think we're at the beginning of a big structural break in our economies for the reasons that you've mentioned, And so all these things are not really in the models. We must, I mean, to be quite frank, this is not in our model. So all of our models kind of have difficulties when there's a big structural break, but it's clearly not in the models of, I would say, the internal models that also banks are using to calculate their capital needs and the risks on their balance sheet. So we are generally concerned that macroeconomic risks going forward might be underestimated. So that's why the countercyclical capital buffer was increased to 75 basis points. And then there was a capital surcharge for real estate risks and strong guidance also to the to market participants, to the banks, to be careful with lending practices. So should monetary policy react to this? So I mean, generally the question is what happens if interest rate rise? And I mean, very briefly, I think the main messages, and others have mentioned this here. So a gradual increase in interest rate would certainly be good, quote unquote, for financial stability. So any abrupt increase in interest rate, which may be triggered by monetary policy action, which is delayed, but which can also come from the market, that would be more problematic. I think this is what our financial stability work shows, and what also the work by the ECB is showing. I think what others have mentioned already, so I don't have to go into the details, the approach that the ECB and the Governing Council is now taking to say, well, we have to monitor financial stability issues more closely. We have to make that part of our policy discussions in a more structured way. I think that's a very good approach. I would warn against starting to trade financial stability against financial stability in terms of the policy objectives. So I think the policy objective for the ECB is very clear. That's price stability. And we do have macroprudential policy to also deal with risks to financial stability. I think it's the more targeted instrument. So to say it briefly, macroprudential policy is the first line of defense against vulnerabilities in the financial sector. These vulnerabilities, this is the bottom line of what I'm saying, have increased over the past years. They haven't weakened because of the pandemic or because of what is happening now. So we have to be very vigilant. Thank you.
So now we're in the second round of the session, and maybe we can move to more structure or more long-term challenges. So if we expand the time horizon of our discussion, we have discussed the more pressing issue that we expect to face as we move away from this accommodative monetary policy, as you all mentioned. But are there any lessons learned in the past several years that we can use in the future, more specifically? Are we equipped in terms of our toolkit for the future crisis? For instance, one of the key elements of the pandemic response was the decision to address early signs of fragmentation through flexible use of asset purchases. We all know that PEP was quite efficient. The decision turned out to be highly effective and in mitigating market stress and providing support over the duration of the pandemic. So, Governor Vasle, small open economies like Slovenia are more exposed to exogenous idiosyncratic shocks that could affect an effective or local stance of monetary policy. So do you think this justifies the use of flexibility, and that in general flexibility is something that should be put into our standard toolkit in the future?
Allow me to start again with the period at the beginning of the outbreak. Then, of course, the pandemic was a worldwide phenomenon, but mitigating measures had a different effect on different economies because they were simply structured in a different way. Some sectors were more important in some countries, and some of the measures had a bigger impact on these countries. So what we realized early at the start of the pandemic is that was causing significant disturbances in some parts of the financial markets, and that our monetary policy was not its effects were not the same across all jurisdictions. And that was the basic reason behind the fact that we reacted so boldly, not just in terms of the size of our instrument, but also in terms of their design. That's why we adopted so much flexibility with our PEP program. Now, going forward, it proved to be a very effective measure. It helped us to go through the crisis with less consequences that we would otherwise witnessed. But the fact is that we ended new purchases under the PEP program, and all the flexibility was transferred to this reinvestment phase, which was actually extended for additional year. So at the moment, we are convinced that the flexibility we are providing to the markets, to the whole euro area is sufficient. We are always stressing again and again that we are prepared to cope with specific issues which would need additional flexibility, but at the moment we are not very specific on how this flexibility will look like, because it depends on the future developments on the financial markets in our real economies.
Thank you. So if I continue where you left, maybe we could argue probably that monetary policy normalization could use support from other policies like macroprudential policies, and that financial supervision framework have been significantly enhanced after 2008 recession, and in similar manner as flexibility did during the current crisis, enhanced the total central bank toolkit. So furthermore, several new institutions have been established in the context of the banking union. So Vice President Vuich, in your opinion, what are the remaining challenges in these areas going forward? What do you see as the main risk to financial stability? So you have more time.
Before talking about the challenges, let me also say what I think has been achieved over the past years, decades since the global financial crisis, and maybe that tells us also a bit of a lesson for what can be done in other policy areas, what can we learn there. So we also argued after the pandemic, maybe there's something a little bit, it's a different policy topic, but maybe there's something we can learn in terms of building resilience from what has been done in the financial sector. I'm not saying that everything is perfect, and that's why we are there, that's why we're doing macroprudential and microprudential work, but I think we do have an institutional framework now in Europe which is actually helping to look at financial stability risks that also spill over across borders. So, I mean, in essence, what we have is what I would describe as national responsibility for core areas, policy areas that affect financial stability. So when you take the example of the housing market, there's a lot of preferences, specificities in terms of institutions that are very country specific. So I think this is what I'm always telling a domestic audience when they start complaining about whatever Europe or the ECB or Brussels is doing. Then I say, well, financial stability is our national responsibility, so we can't complain if it goes wrong. But at the same time, of course, we have monetary union, so we have a common monetary policy for all Euro area members, and for monetary policy to work in the Euro area, we need to make sure that risks are properly addressed at the national level. So we can't just rely on the national level, and we need a coordination mechanism. So the measures that we took, there's reciprocity for some of these measures, so that we make sure that we also take cross-border spillovers into account. And so this is basically the ESRB and also the Financial Stability Committee of the ECB organizing that coordination and making sure that also issues that are relevant for the euro area or for EU, as for that matter, are being addressed. And I think that's actually quite a good institutional structure. It's complicated. People who are not operating within that structure might find it confusing, but I think the structure is good. But as with all good things, we also have to make sure that it's working as intended, so that we don't have inaction bias at the national level. There might always be the tendency to say, well, we don't do anything about the housing market because we are afraid that it's hurting new borrowers. And there might also be inaction bias at the supranational level. So there's this, it's maybe a bit technical, but there's this top-up power from the supranational level, and that might also not be used sufficiently. So I think this is what we have to do. I mean, we're all analytical institutions. We have great experts around the table, so we have to really make sure that we monitor what has been put into place. We have to look at why certain decisions are being taken, and then also identify in case there's an action bias. And I think we have all the people and the skills and also the data by now around the table to actually achieve that.
Okay, so just now to say a few words about structural changes. They affect the economy and policy more broadly, actually, but they're also related to financial stability. So in coming decade, European economies will have to adapt to many structural changes as a result of demographic changes, green transition, digitalization, we heard a lot about before. So some even warn that the current war in Ukraine could put an end to globalization we have experienced over the last decades. So at the same time, many argue that at least some of these structural changes could persistently increase actually inflationary pressures. So Governor Centeno, how can monetary policy respond to such structural changes? To what degree can the euro system support the transition of European economies to a greener, more digital, albeit some kind older and likely less globalized future?
Well, that's a very complex issue, but well, we need to understand that monetary policy is macro in nature. So it is quite challenging to bring to the spectrum of monetary policy issues that are of a more targeted nature. And that's precisely where coordination kicks in. But I don't want to come back to that point. And instead, in answering your question, stating the following. We facing with structural changes, the best thing that policies can do is to be predictable and to lay down the major guidelines so that then economic agents can take their decisions. And that's a pretty standard, of course, view of this process, but it really is important for us to establish in Europe a quite comprehensive set of institutions that we still need to complete. Claudia mentioned a few of them. They, as intricate they may sometimes seem, they are not yet complete. And I remember that in 2019, one of the big political flags in Europe was to increase the international role of the euro. And for that to be true, or to be a reality, we really need to complete this institutional setting, the banking union, the coordination of fiscal and monetary, eventually adding a fiscal dimension also to the euro area, a central fiscal dimension. Actually, the embryo of that was approved in the European Council in December 2019. It was a quite important experience to design the next generation EU. All the debate that we had in Europe prior to the crisis was very, very important to the success of the response. And monetary policy enters in this overall picture, providing stability. The review that we made to the strategy in July 2021, that we approved in July 2021, as a green action plan attached to it. The ECB, the Eurosystem, did not put itself outside this dimension. So we need to continue that way. And the buzzword for me is always, from a policy perspective, to provide stability. We are the big suppliers of patience in our economies. we always need to take that very seriously. So the gradualism also plays a role there to act on a predictable way. And I think that's the more natural place for monetary policy right now. We are going to enter, we actually entered already into a process of normalization of policy. Again, that must be predictable. Moving our decisions around does not operate in a single step. It is a sequence of steps that has a duration, that has a magnitude. All that must be predictable to economic agents, because we are not here to provide surprises to anyone, and that's contradictory with this idea of being gradual and patient. So I think that's the natural place for monetary policy these days.
Thanks. Thank you. So now we have the last question, not less important. So zooming in again among these long-term structural changes to the technological progress aspect, the European Union has set the digital transformation as one of the key strategic priorities. So Governor Müller, Estonia is known for the advancement that it has made in terms of technological progress and digital transformation. So how do you see the digital transformation affecting central banks going forward? And why is the Digital Euro project important?
Well, I think indeed we all have seen that our lives are becoming more and more digital, the economy is becoming more digital. This was given a further boost by the pandemic, where we had to manage our everyday lives and business and work from home using the help of technology. And this is a trend that also the central banks have to go along with. You mentioned the project of a digital euro, and this is indeed, I think, an exciting possible future project. We haven't really decided that there will be a new format of the currency, but the work is undergoing. We have initiated what we call an investigation phase, which started last October and will run for 2 years, where all the possible technical aspects, the scope of such a future, the digital currency, and all the other sort of practical issues will be discussed. But very briefly, what we're talking about basically is issuing then currency in a different format, so that people who in the future might want to use payments using the digital wallets and some new blockchain perhaps technology would not have to use only private sector solutions or some also central bank digital currencies provided by other countries, which at the end might become global, but indeed that it would also be possible to use real central bank euros in a new way for retail payments, from person-to-person payments. But then also there's a separate line of analysis when it comes to possible wholesale uses of digital euro. We of course have already today offered by the central bank, there's a system for large-scale payments, security settlements, but I think it's worth studying indeed if the new technology provides possibilities for further efficiencies. Perhaps we need to upgrade the Target 2 system, as we call it, that we have now in place. And the work on that is also ongoing. Of course, there are also risks involved. I think very practical question is today if we have, in fact, already instant payments in Europe, and you can very easily and quickly transfer money with existing technology, then I think a reasonable question is what can we really offer in addition to incentivize people to take on this digital, even more digital euro. Even of course the electronic payments are in a way digital also today. So there has to be real value added to customers. And once it does take hold, there are possible implications also for the financial sector. if you make it too attractive and people want to move all their savings from traditional banks to their digital wallets, that might create problems for the banking sector. That this has to be balanced in a smart way. And I think we have to also, in terms of risks, I think we have to acknowledge one of the rationales behind the project is an understanding that if indeed people were to use on a large scale some alternative global virtual assets or currencies, we as a central bank would have a much more limited ability to have effective monetary policy and guide the economy. So I think there's a practical need for the ECB also to come up with our own solution. But the work is ongoing. We cannot really report on any specific results yet, but I think it's an interesting project and something that, unlike many things that the central bank does, people could actually physically almost touch it or have in their phones. So it will have a direct impact for all of us.
So, thank you. So there are a lot of challenges, but also opportunities in front of us, and I think that we still have 5 to 10 minutes for questions from the audience. So, if there is any question. In the back. Yeah. Thank you. Yes.
Hvala. I am Andrej Rand. I'm a retired central banker. I was very pleased this morning to hear from Mrs. Lagarde, President of the ECB, that there is a direct link between the poetry and the central bankers, between the emotions of heart of a human being and between the emotions of heart of central banker. Both the fate of both hearts is faced with one blow after another, as we heard. We are in the middle of the discussion of the future of Europe. There are different parts of this discussion. One of them is focused also on central banking and on central banks, and especially on the relationship between the expertise, between policy making, and between democratic control through the representatives of the people in the parliaments. So in November, for example, there was a book published of Eric Monet. He's a full professor of Paris School of Economics and School of Advanced Studies in the Social Sciences, as well as he's a research affiliate in CEPER. The book is entitled La Banque Providence, Providence Bank, and it is focused on democratization of central banks and on democratization of money. In March 22, there was published a Revue d'économie financière with new doctrines in central bankings, with large contributions of experts, former central bankers, policymakers. Among them was also a contribution of Pervenche Beres, who was also a representative in the European Parliament. And she thinks that in the relationship between the Parliament, between the European Parliament and the ECB, should be rethought to achieve more credibility and legitimacy given all the events which happened after 2007, especially two. Unconventional monetary policy and side effects, and a broadening interpretation of ECB mandate. So I don't know how much are you acquainted with all those discussions, but this discussion certainly is important for the broader public. And I would appreciate if you could exchange on this issue some of your thoughts and of course some of information if you have it, because it would be interesting for us to see whether those discussions will bear some fruit or will be just put in the shelf. Thank you.
So, anybody would like to start?
Well, I can start. I already switched sides several times in these debates. Institutionally, of course. The reasoning is a continuous move process. Well, I think your concerns are very well taken, but my answer will be that we as a society that is inclusive or that we want to be inclusive in nature need to prioritize and define the role of each institution in providing our citizens with an environment that is adequate to meet all the goals of the European Union or each member state of the European Union, which is, in my view, the same. And this is translated into the treaties, into the mandates of the Euro system as well. And the priority we give and we attach to the price stability is because we understand and we believe that it is an important feature of an economy to develop, to provide conditions for full employment, to reduce inequalities, to provide financial stability as well, and also the climate issues. Those are all listed in these articles. And scrutiny is important, and scrutiny is a different topic probably. And I think over the last years, that scrutiny has also increased, but we definitely need to continuously improve on that. That does not challenge so much the role of a central bank, but the position it places in the context of the institutions of our union in terms of delivering these goals. In my first intervention, I mentioned the coordination, the key aspect of coordination of policies. I also mentioned already that on occasion there are conflict interests that must be made very clear in terms of the communication. Because when we say as central bankers that we are data dependent, that means that we are citizens dependent, because data means citizens, means firms, means households. It's not an abstract theoretical issue. So I think we need to be at the core of our citizen sentiment, and so I totally agree that we need to do more, but in the vein that is established in the integration of our union. Actually, 2020 was a huge and represented a huge leap of integration for Europe, and I think we need to continue in that vein. Thank you.
I think Vice President Vuich will also like to comment.
Yeah, thank you. I was intrigued a bit by also switching sides, and I've also switched sides, but in a different way, namely from academia to central banking. And I should say that I think in much of the academic work, what economists are doing, these issues about institutions and mandates don't really play a prime role, to let me say it that way. So we look at the economy when we don't think about the issues that you have mentioned in your question. I'm sure I'm doing injustice to a lot of people who are thinking about this, but I've come to learn and understand that it's really crucially important, and I very much agree with Mario, that we are aware of our mandates, we are aware of who gave them to us and what that means for us in terms of transparency and accountability. So I think this is crucially important. And I also find, I mentioned the example of the Financial Stability Committee we have in Germany, and other countries have similar committees. I think it's important that the different participants in these committees bring their mandates and bring their objectives to the table, and then we discuss what's the best solution giving those mandates. So I'm strongly convinced that that's important, and I'm afraid I don't know the specific sources that you've mentioned. It would be interesting to take a look. I think Paul Tucker's book, I think it's called Unelected Power, is also very interesting to read and to look at the different mandates, and that's also one of the messages he gives. And I mean, very specifically to the keynote we heard earlier today, when it comes to climate change, I think there's actually a lot that central banks are doing through their mandates. So having stable prices is crucially important to also extract relative price signals from markets. Financial stability, and that was also mentioned, is crucially important, so that actually the climate transition can work, that innovation and investment is being financed. But when it comes to taking policy decisions, how to set CO2 prices, how to compensate the losers, I think this is not within the mandate of central banks. So this is what government should be in charge of, and it needs democratic accountability. And we are all not elected; we're technocrats. Not a very nice word, but that's what it is.
So we have a few minutes for the Governor Müller. If also you want to.
I can add a few thoughts, unless there's I don't see a forest of hands for additional questions. So. I think it's a good point about the question about the accountability and transparency of the central bank. And then indeed, I agree with the previous comments, and I think it goes hand in hand with the independence, or it's the other side of the coin when it comes to the independence of central banks conducting monetary policy. I think it's important that we have the independence and there is no political interference when it comes to monetary policy decisions, but at the same time, obviously, we need to be accountable for what we do, and we need to report to parliaments. The president of the ECB regularly goes to the European Parliament. We all go to our own national parliaments and explain how we are meeting our goals, exactly dealing with everything what to do within our mandate. And I think it's important that we stick within our mandate, otherwise we might be questioned, and also that we reach our objectives, because otherwise people might start asking if there's something wrong with the system or the way that the central bank works, that we're not delivering the results that are expected from us. So I think in the recent couple of years there were questions about, in some corners, about the very accommodative monetary policy. We had a lot of explaining to do, why we have the monetary policy in place as we did. I think the central banks were put in a difficult position, because historically central bankers are used to fighting a very high inflation. As firefighters, now we were basically asked to invent matches and start fires, which is not what we are usually been doing. And now going forward, I think there's similarly the issue that if Boris in the first session referred to perhaps the Greenspan's comment about 5% inflation being the critical level above which you shouldn't go, then clearly we now have an issue and how to deal with a high level of inflation. But at least we know what the tools are, so we just need to deliver.
Thank you. So I think we are run out of time for additional questions. So thank you for your valuable discussions. And I think we can leave the stage and...
Thank you.
So, ladies and gentlemen, dear guests, before we let you go, just allow me to address you for the last time. I think it was a very interesting day. We made a long journey through it from the beginnings of our institution, from other institutions, from the reasons which were behind specific setups, so why we are here at this point today. And this point today, as we heard in the second part of the conference, is a very complex world with the big challenges ahead of us. I'm convinced, and I think we all share this view, that the future is, or the current situation and the consequences for the future are very complex. Our decisions will be made in a different environment, whereas at the beginning of the outbreak of the crisis, of the COVID crisis, our economic shifts were more aligned and we were able to target actually with one policy more goals. The situation will be very different today. And that means that our decisions might not be so popular as they were before. And therefore, it's very important that our institutions, concretely Bank of Slovenia, but also other central bank and the ECB as a whole, remain credible. And here I would like to thank you again for being part of today's event as a guests, speakers, panelists, because your contribution is very valuable also in terms of contributing to our credibility, which will be much needed in the future. So thank you very much again for being part of this conference today.